U.S. growth both accelerating and surprising to the upside. That's something that's going to change.
The U.S. economy near term will probably be slowing down.
When I look at the bond market, it's pricing in a slowdown. When I look at the equity market, it's not.
What people have been doing all year, which has confused me, is sold bonds but said that they like them.
Right now, we're still in the annoyance phase of inflation. That's why we think it will persist.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowitz, and Tom Keene on radio and television. It's FX Tuesday. We're looking at markets that speak volumes. Futures at negative 25, more substantially lower than where we were 24 hours ago. Dow futures at negative 160. The VIX was an 18 level, 17.66, but away from the markets. Lisa, foreign exchange is a litmus paper for the system this morning.
The dollar very much front and center. It has been, although giving back a little bit of it. The irony here, as we talk about dysfunction in Washington, D.C., and the haven of choice, is the dollar, the currency of the nation, which raises a question, are we hitting a breaking point? And that's something you've been asking quite a bit.
Well, it's a theme that we're going to go through today. And Lisa, of course, has got an edge of gloom over what I'm doing here. But, boy, does each pair and the triangulation of foreign exchange speak to what we see in the bond market. We'll do it in a data check today.
You buried the lead. We came in and having like a real argument about how much gloom was warranted. You said this is something that always happens in this time of year, and it feels different to me. I do think that the yield space feels different because there is this backdrop of what does it mean if you have rates that can keep climbing, potentially, if you listen to Jamie Dimon, to 7% in the face of strength, does that lead to weakness in stocks?
We're going to get the Dimon comments, and he looks out at the least, I guess the least likely outcome, but it's a gloomy outcome of much higher interest rates. We're also going to have John Ferro on assignment. Let us announce it in the 7 o'clock hour. Mr. Ferro, in conversation with the former Prime Minister of the United Kingdom, Gordon Brown, Michael Spence, the laureate of NYU, and of course all his work at Stanford, and Mohammed El-Arian. This book is anticipated Permacrisis. Bramwell came up with a title, and there it is, Permacrisis, and it's about, okay, how do we extract ourselves from these post-COVID challenges?
Especially at a time where we are readjusting to new rates. And that's really the underlying question. Can we get to a new rate regime of higher rates without something breaking? And people keep asking that question. The answer was yes, yes, yes. And now people are saying, well, if it keeps climbing from here, are we still so confident that nothing will break?
We're leaning on foreign exchange today, but let's go to the bond market and talk quickly about this, Lisa. What I want to know from you is if I see a real yield out to 2.17%, 5-year real yields is up, is well, if I see 2/10s disinverting, if I see that 450, now 451 on the 10-year yield, what are spreads telling? Are they finally a corporate and high yield spreads giving away?
A little bit, particularly on the riskier sphere. You are seeing a bit of spread widening. In other words, the premium is increasing that investors are charging over benchmark rates. But the key question here, again, is when do risk assets fully adapt to this idea of higher yields? Bank of America strategists put out this morning. Do rates really matter for stocks? And I would say for all of risk. If so, it's not priced. And this has basically been the theory at a time when yesterday the 7 magnificent tech stocks did just fine, even in the face of the highest yields going back more than a decade.
Look at the Tesla news here. As Tesla was down a little bit here off some news. We'll talk about that in a moment. Let me do the data check. And today we lean on foreign exchange. It's what Bloomberg does best. Futures at negative 23, the VIX 17.59. In the yield space at 450 level, Lisa was talking about 451, and we were higher much earlier, 511, 512 make it on the 2-year yield. Oil doesn't give me much, 92 on Brent. And in foreign exchange, we could go on for the hour. We won't. Yen, a 149 level. DXY, that blended major trading partners breaks through. Simon, give me that chart if you would. This is the Bloomberg Dollar Index, folks. And this goes back to the financial crisis, back to 2007. And this has been the great missed call on the street. Everybody looking for weaker dollar, and the all-in what's called BBDXY, Bloomberg DXY Index, up 5.7% since mid-July, and they're back back. That's something. Brief us, Lisa. Brief us.
Here's the data that for today. It includes a lot of information about the housing market, which a lot of people would say is broken. We get some U.S. house price index data throughout the morning. And this is really what I'm watching. And this is going to come out at 9:45 a.m. The S&P Case-Shiller year over
for
year
radio, that's an off the cliff chart.
of pricing that we have here, which you're seeing declines that we have not seen going back to 2012. We also get consumer confidence data, as well as the U.S. Treasury auctioning off 2-year notes, about $48 billion of those at 1 p.m. 12 noon, President Biden joining the picket line in Michigan with UAW workers. Politically fraught, but this is viewed as a win for him because he has actually gotten the support of them a day before the former President Trump heads to the same area and tries to recruit the same votes. And then at 1:30 p.m. Eastern, Fed Governor Michelle Bowman is planning to speak. And this comes after yesterday we heard from Neil Kashkari. He still expects one more hike by the end of the year. Again, there is this bias for, yes, higher for longer, but maybe that the risk is still to the upside in terms of how high rates have to go.
We'll have to see. We're going to talk about that. Ben Layler with a smart note out this morning. Right now we get to our guest and very experienced. Russell Kosterich is Global Allocation Fund Portfolio Manager at BlackRock. What are you doing now? The bears are out in force. We're not down all that much in the equity market, but bonds move. What are you doing, Russ?
Good morning, Tom. Right now, the truth is we're kind of holding steady. I think that we're seeing right now there are a couple things going on. The first of which is you have seasonal weakness. We have it every year this time of year. So far, it's about what you'd expect, but as Lisa mentioned, there are some other issues. Two things that I think you've got to be aware of. The first of which is we're back in an environment like 22, at least temporarily, where you're punished for high volatility, low quality assets. The market is rewarding consistency. And if you're an early growth stock, you're an EM stock, you're a small cap stock, you're getting penalized. So focus on going up in quality. And the other thing is, clearly we're in an environment, as we've been for much of the last 2 years, where bonds have not worked as a hedge. What has worked is the dollar. In an environment where people are scared of the Fed, they're scared of what central banks are going to do.
Did I lose Russ?
The dollar works.
Russ? Why don't you pick it up?
Russ, there's a real question here as you talk about being more cautious, what that means in an era where bonds are not the cautious bet.
I think it means that you have to think about where else in your portfolio you're going to get that hedge. Again, for 20 years, bonds were remarkably good. They gave you this incredible risk-adjusted return on a portfolio, and we haven't been in that environment now for coming on 2 years. So what do you do instead? I think you do a couple things. In this environment, as I was mentioning a moment ago, where the Fed is probably the shark closest to the boat, the factor that's most disrupting markets, the dollar can actually be a very effective hedge because it's negatively correlated with stocks. The other thing to think about, watch the volatility in your portfolio and look for quality. Look for companies that are generating consistent revenue, generating consistent margins. You mentioned before, the Magnificent Seven did well yesterday, despite the fact that rates were surging. Part of the reason for that is most of the names in that little group, they generate tremendous cash flow. They're not the ones that are most at risk. The ones that are most at risk are the early growth names that their cash flow is 10 years in the future.
Interesting. Lisa, I'm sorry, I lost my audio there to Russ. Did he mention the triple leveraged all cash fund?
Well, he's talking about the triple leveraged dollar fund. And I want to pick up on that, Russ, this idea that the dollar is really the best hedge against equity volatility. Are you basically saying that it will ignore and possibly even be an even better bet, regardless of some of the circus going on in Washington, D.C.?
Well, I think that in the time frame we're talking about, yes. Now, just be clear, I don't think you stay long the dollar till the end of time. One of the things about this environment is your hedges are changing. Back in March and April, bonds worked because we were worried about another banking crisis. Since the summer, the dollars work. So it calls for a more dynamic portfolio. But again, I'd say two things. Right now, in an environment where the Fed is what investors are most concerned about, the dollar's effective. And I would guess that the market is going to look past some of the shenanigans in Washington and focus more on what the Fed is doing than what's happening in Capitol Hill. if we're worried about rates grinding higher, that dollar's still likely to be negatively correlated with stocks.
Russ, what's your sense of this Jamie Dimon call for 7% rates eventually, if that's a possibility? Do you also see that as a possibility, that the risk right now is to the upside in terms of benchmark rates, and that eventually will cause an end to the rally that we've seen, even in the Magnificent Seven, which you do like?
Well, sure. Look, I think we had a 7% on the policy rate, or even 7% on the 10-year. That's going to disrupt markets. We have a very levered economy, and I have a lot of respect for Jamie Dimon. That's not obvious to me, because I think a couple things are happening. The economy is slowing. Inflation is decelerating, albeit at a very uneven pace. And I think there's some recognition by the Fed that if you tighten financial conditions much more, you're going to do real damage to the economy. And let's remember, since the Fed's last hike, real rates in the long end have gone up quite a bit. The dollar's gone up, and we're seeing more contraction in credit and lending. So I don't see us going to 7%.
Ben Laidler with a blistering short note this morning, Ross, and I thought of you actually. And he's talking about the Fed put coming back. And not played into this is how the Fed responds a la Greenspan 15, 20 years ago. And I think what you're suggesting here is the Fed has a lot more power to change the dialogue if they get the data and if they choose.
I think that's right, Tom. And I would also say that I think between the renewed bond vigilantes that we thought were gone and who clearly have come back, and the dollar, and we're seeing in lending markets, some of that tightening that the Fed was concerned about to slow the economy has already happened outside of the Fed's actions.
I look at the correlations today, and clearly it's going to be a foreign exchange Tuesday, folks. There's no question about that. Which major pair is your closest study this morning?
I think that the pairs that generally we're thinking about have been the ones that are representing the DXY. So, they're the large pairs, whether you're talking about the euro and the yen, and there are others as well. But again, what we're thinking about here are the rate differentials. And if we continue to see an environment where, justified or not, the concern is the Fed's going to keep going, that's going to favor the dollar on a lot of these developed market crosses.
Russ Kostrich, thank you so much with BlackRock this morning to get us started. Here, Lisa, which pair are you looking at? I mean, I know it's a game here, but today, it really is, folks, Foreign Exchange Tuesday. I mean, that's where we are. What are you looking at?
Well, I have been looking at the euro, this question around how far and how deep it can weaken versus the dollar. But in general, I just think it's fascinating that the dollar is sort of the haven call, regardless of the fact that the U.S. is the epicenter of a lot of the political drama. And so at what point does this sort of create a difficult moment for the rest of the world?
Well, what you do, folks, like on euro yen that Mr. Kostrich just mentions, is you take dollar yen or euro yen, and you have to triangulate which pair gives you the most information. Right now, I'd say it's dollar yen, because you're buttressed right up where we've seen MOF and BOJ. It's an alphabet soup, EIEIO. But you see where they intervene in Japan.
Well, here's the issue. And when you take a step back, there's this feeling that suddenly we have to readjust to a higher for longer type of regime, this idea that maybe this isn't going to kill inflation. And if you have that kind of regime, everything is going to have to reset higher, including in Japan. So people are still going to be gaming out when they're going to have to abandon their negative yield policy.
Let's look at the calendar. End of September. Okay, it's end of September. We're going to get some data in. We do have the shutdown. Very important. Greg Villiers writing about that today. But the heart of the matter is we're starving for data. We get the jobs report, and then, let's assume the shutdown gets fixed, an inflation report. We're going to know a lot more going into middle of October than we know right now. Maybe that will calm down where we are.
Honestly, the idea that we're not maybe going to get some of the data is going to be a real concern, right? I mean, how much does that affect the Fed? To me,
how much does it affect us? Did you see
risk.
The 30-year mortgage rate? 7, went right back up to its new high. I believe in this morning's print, the bank rate's going to give you a new high for a 30-year mortgage.
Do you think that we can call this housing market a market at this point? I mean, is it really a market, especially of existing homes, if you take a look at some of the sales?
I think it is the price of what we've seen in central bank action is what I think. It is an amazing Tuesday here to synthesize it. Emily Rowland in the 7 a.m. hour with John Hancock. Stay with us, Bloomberg.
I have haven't talked to leadership. I've talked to all of Congress saying it is irresponsible and inexcusable that you would let government shut down.
And what's the response?
It is also irresponsible and inexcusable to not cut all of this spending. They are using our budget and keeping it in pandemic spending. We're no longer in a pandemic. Why are they still spending at those levels?
A Republican candidate with some visibility. Help me, Lisa, here. It's tomorrow night, right?
Yes,
Nikki
it's tomorrow
Haley
night
speaking
in
with
California.
Alex Steele, American Energy Security Summit, Oklahoma City here. We're going to get shutdown updates through the morning here. But as we look at the markets, we're going to also dive into some very careful analysis of the budget. We'll do that in a moment. If you're joining our equities with some weight to the tape here and down 22 on the S&P 500, that is more than yesterday. Were you surprised, Lisa, by the little uptick? I mean, we got some green on the screen yesterday. I'm like, really?
Yeah, driven by the big tech. It was really surprising. And again, it goes to this question, do they care about rates being higher?
Yeah.
Rates were hitting, multi-generational highs, and yet stocks kept grinding it out, especially the tech stocks that, remember when we used to think they were interest rate sensitive?
Well, yeah, but I'm going to go back to, fiscal 101. The real rate is 2.15% this morning. It was 2.17. And just as one talking point, given UAW, I saw auto delinquencies on loans. They've moved. I mean, there's a tangible bad news there.
Do you want to hear my fear? My actual fear right now is that people are basically so sick of talking about recession that they've taken the bad outcomes off the table. And everyone has basically bought into this idea that the economy is resilient and can keep going ahead, even as people start to feel the strains of higher rates in a more material way because there are long and variable lags. And that it will become as a surprise after a year of people getting the recession call wrong.
Bramonomics there, and of course that pushes up against soft landing, which was last week's story. And right now, we don't see that. And foreign exchange market at 106 on DXY is of note. Yen out near a 149 level globally of a great note. Cable, John Farrell mentioning this too. I mean, look for his interview of Permacrisis in the next hour with Brown, Spence, and El Arian. Sterling 121.83, ever weaker here. You really wonder where that's going to end up. Right now, without question, our interview of the day on our debt, our deficit, the famous Heilbronner Bernstein monograph of 30 years ago. Maya McGinnis doesn't remember that book. She's too young, but Maya McGinnis truly owns a high ground on debt. She's the president of the Committee for a Responsible Federal Budget, an equivalency there to what we see at the Congressional Budget Office, and we're thrilled for this brief this morning. Maya, yesterday in the mist, somebody said, let's bring back Simpson-Bowles. We've done this before. We've had independent commissions, and then the politicians ignore those commissions. Is that where we're heading?
Well, I actually do hope that we're bringing back a commission, because one thing is certain, which is our partisan politics are not going to resolve this issue, let alone really confront the huge fiscal issues that are the things we should be talking about, right? Keep in mind the policies that we're about to shut down the government over, it looks like, are just a tiny fraction of the government. And what we have is a situation where our politicians, in the moment that we are facing record levels of debt, interest payments being as much as defense spending in the next few years, a whole long list of risks, our politicians are promising not to do the things that we actually have to do to fix the budget, whether it's raise taxes, reform Social Security and Medicare, or continue to cut spending. So I do think the idea of a fiscal commission could help insulate the lawmakers from the hard choices and the really difficult politics. But as you pointed out last time, Simpson-Bowles didn't even get a vote.
Yeah.
So we need to build in a process where it is guaranteed to have a vote if they come up with something through an expedited process, again, to insulate it from the really poisonous politics on this issue.
Maya, the primer for all of us on this, including Pete Peterson and others, Paul Tsongas, that led the charge on a responsible debt, was Heilbronner and Bernstein's The Debt and the Deficit, this 34 years ago, folks. And what they basically said was, everybody calm down. You're conflating family accounting, which is what we all use, Maya, versus the accrual mysteries of the federal budget. Is this budget like what Heilbronner and Bernstein knew, or is this budget out of control?
Well, this budget isn't like a family budget for sure, because we have the ability to tax. but it also isn't a budget where any of the signs are saying, don't worry about things. For years, we actually had people saying, interest rates are so low, don't worry, we have the printing press, we can borrow all we want, we can print money. Now we saw that fiscal policy helped kick off the inflationary situation that we are in. And that even though interest rates were low for a long time, now that they've gone higher, and we have this much greater debt because we did borrow so much in the past decades, not just for COVID when it made sense to borrow, but when the economy was strong, when it was counterproductive. Now, with every small increase in interest rates, our interest payments grow dramatically. And so now we're in this dangerous situation that resulted from people saying, don't worry, there's not a problem. And I would also make the point that fiscal irresponsibility, where we have been, used to be really about an economic threat, slowing growth, leaving us unprepared for big emergencies. But now it's more than that. Now it has really expanded into a national security threat. And our fiscal vulnerabilities are also our geopolitical vulnerabilities. And we have to think about this on the broader stage in terms of the risks we have created.
Maya, is there any party or any member of any party having a responsible discussion about some of the aspects that need to get changed in the budget in order to get to a more responsible budget in your view?
There are a lot of members. There's a group in the House called the Bipartisan Fiscal Forum. There's the Problem Solvers. There's many members of both parties who are talking about the issues. But the problem is you can't go out on your own and say, listen, America, I'm going to tell you the truth. We have to fix Social Security. We have to fix Medicare. We're going to have to raise higher revenues. They can't do it alone, or the attack ads are written before they're done talking. So there needs to be a kind of a bipartisan space where people can talk about this. Again, that's why I also turned to the idea of a fiscal commission to create the safety of a bigger bloc saying it's time to level with the American people. I think it will be really interesting what happens in the presidential campaign. You just had a bit of Nikki Haley there talking about the issue. She's been bringing it up, but we have a situation where both former President Trump, President Biden are promising not to fix entitlements, for instance. That can play well with the public, but it's not the truth. We're headed towards insolvency in both of those programs, and we'll have across-the-board cuts if we don't do something to fix them. So it's really important that we have truth tellers during this campaign to create sort of a mandate for addressing this in an honest way and confronting the trade-offs.
We saw Ms. Haley talking with our Alex Steele there, and it was a very simplistic analysis of this process. And I would suggest many, both Republicans and Democrats, Maya, in Washington, bring this back to basically Home Ec 101. How are we going to do this outside of a commission? I mean, is the committee system that you were weaned on still, like, does the Appropriations Committee still appropriate like in our youth?
So the budget process is plain out broken. And it's not entirely surprising. We put in place budget rules. These were put in place in the 70s. And then Congress slowly figures out how to do end runs around them. They erode, they break, and you reach a point where they're no longer working. Our budget process needs a huge overhaul. Keep in mind, the Senate Budget Committee didn't even bother to put out a budget this year. They just skipped it. And both of those committees skipped it for the past few years. You shouldn't be able to go forward with work until you've put the budget out. So we're going to have to do a major overhaul and look at things like what kind of fiscal requirements are there? How do we insist that budgets are put out? I will say there's a big brewing problem on the horizon, which is we avoided default a few months ago, thank goodness. But we have to deal with that debt ceiling in 2025 again. And I don't think it's going to be a smooth sailing. So I think we have to reform the debt ceiling. We probably need to put in place something like auto CRs, automatic continuing resolutions, so we aren't talking about government shutdowns. But to your question, no, none of this works anymore. The budget rules are being ignored, broken, gimmicked, and we're going to have to do a big effort to fix the budget process and change it into something really different that starts to function again.
Thank you for the brief. Maya McGinnis with the Committee for a Responsible Federal Budget. I can't say enough, folks, of the importance of this. Our Washington team and Bloomberg News will continue to look at this, particularly from groups like that and from the Center, the Congressional Budget Office. Kay Schiller, housing data, you mentioned it in the brief. Negative statistics. Wow.
We're starting to see prices go down. And have they really readjusted to the idea of, what'd you say, 7.75% mortgage rate?
Yeah, that's the mortgage rate. Survey under zero for Kay Schiller year over year. John Farrow in the next hour with Brown, Spence, El-Arian, and David Page next. Bloomberg Surveillance, Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Mr. Farrow on assignment. You'll see him in the next hour, about an hour and 15 minutes from now. Jonathan Farrow from Queen Victoria Street with the former Prime Minister Gordon Brown, the laureate Michael Spence, and also a guy named El-Arian. These are three competent people in different areas, and they've got a book out, Permacrisis, a plan to fix a Bramo world. It'll be interesting. It'll be interesting to see. Is your life a permacrisis?
100% yes, but that's just genetic. I will say, though, there is a concern that people have that we have gotten so sort of immune to this latest rate hike. Yeah. Because if you think about it, people are moving beyond the permacrisis. Everyone was looking for a crisis. Everyone was looking for a quick buck, and it never happened in the past couple of years. Even during the pandemic, it was like, that's technical CFA,
yes,
dip,
good.
and then V-shaped recovery in the stock market, and people have kind of moved on. So what is this new world? Have we actually moved
to me,
past?
the new world, and you see it in the UAW strike, is we're coming out of the pandemic. What definition of that was? I was in the Weill Cornell yesterday just doing the routine checkups. Guess what? They're all back to masks. I was real shocked to go in and say, hey, for us, COVID's still here. I was not expecting that.
Yeah, it is still here. We have people in our orbit that have COVID.
They do.
And
so does everybody else.
Yeah, it's been treated differently. Here's what we're watching this morning. Under surveillance, Minneapolis Fed President Neel Kashkari saying he expects the U.S. will need to raise interest rates one more time this year. This builds on what we heard from others. He was at an event in Wharton saying, quote, if the economy is fundamentally much stronger than we realized on the margin, that would tell me rates probably have to go a little bit higher and then be held higher for longer to cool things off. J.P. Morgan's Jamie Dimon weighing in. Tom, I know you have a lot to say on this, saying the world is not ready for a 7% Fed rate, and that going from 5% to 3% is going to be more painful than going from 3% to 5%.
These are two smart guys, very different, but yet they're all on common ground here. They're looking at the probabilistic distribution of what we're going to do. And Dimon in that comment, which I'm going to suggest Dr. Kasman and Dr. Feroli maybe don't agree with, but he's just simply looking at one tail, one outcome that could be out there. The aerospace engineer from Minneapolis has a key word there is margin. We heard a lot of Newtonian calculus yesterday. Kawa wore me out up at UBS. But the answer is people here are looking at the marginal, the first derivative, the second derivative within what we're seeing in bonds and FX. 106 DXY, I'm talking calculus.
Well, what I'm looking at is this idea that the risk is increasingly to the upside, and that everyone who talks says that the risk is the economy has that much more strength behind it than people expected at a time where we are back to pre-pandemic times when it comes to the savings rate for the vast majority of people in the United States. So is that accurate? Where is the risk? Is it going to be on the downside with respect to economic data, or is it going to be on the upside with respect to strength?
Talk to David Page here in a moment about these things. What else do we have?
The Senate. It's nearing a bipartisan deal on a short-term spending measure. Sounds like it's progressive, right? Could avoid a government shutdown. And Bloomberg reported the deal would extend funding for 4 to 6 weeks after the October 1st deadline. However, and this is the big caveat, could put a lot of pressure on House Speaker Kevin McCarthy, because basically, Tom, if he has to bring this to the floor, he could face some sort of loss of confidence vote that leads him to lose his position and then total disarray in the Republican Party.
Folks, can they just talk to Maya McGinnis? I mean, that's, talk to somebody sensible about this.
Yeah, well, part of the problem is that do voters actually want to hear it?
No, they don't. No, this is the smartest thing I've heard on this analysis. You're 100% correct. Call up Orzag over at Lazard. He's expert on this.
Well, but this is the problem, is that essentially, can you have an honest discussion about finances if people don't want to hear the truth? And that essentially is what happens time and time again. I'll get off my soapbox. The crisis at Evergrande deepening after the company's mainland unit said it failed to repay an onshore bond, adding a new layer of uncertainty to the property developer's future. This comes as Caxton reports that the company's ex-CEO and ex-CFO have both been detained by Chinese authorities. I'm not sure what that's going to achieve. There is this feeling, though, of just deepening distress in the housing sector in China that is being allowed or at least uncontrolled by the government. And this raises a question, how far it will go and how much the exposure could be contagious.
And the devaluation of renminbi, we're at 7.31. No one ever thought we'd get here. You wonder, do you get back to that 7.52 level of 2015? You can say, oh, that'll never happen. But given the domestic balance sheet issues, that's how you devalue a currency.
You know what's funny, though? In so many notes that I've been reading, everyone's been saying they're going long China because it's gotten so beaten up in terms of the assets that people are like, well, you know, how bad can it get? It's already basically pricing in all of this, and the government will help at least on the periphery. So we're talking gloom and doom, and other people are saying, yeah, we know this
You're
already.
talking gloom and doom. I'm not. Why don't you bring in David Page to holistically, you know, he gets to work with Gilles Moek. That's pretty cool.
That is pretty cool. And Gilles Moek gets to work with David Page, which is even cooler. Head of macro research at AXA Investment Managers, joining us here on set in New York. And David, I want to start there. We keep talking about the balance of risks to the upside with respect to rates, with respect to growth. Do you think that that is the greater risk than the risk to the downside right now?
I mean, it certainly has been, and we've seen that come through in bonds, but I tend to think that we're really at a peak now. Going into the summer, we were having the debate, is it going to be a soft landing, is it going to be a recession? Coming out of the summer, it's, is it going to be a soft landing, or are we going to have no landing at all? And I think that creates a dangerous backdrop, and I think you were talking about it a little bit earlier. So I think what we're seeing now is a backdrop where actually economic data are going to start to look a little bit harder. We're starting to see it in a little bit in the September sort of early retail numbers coming through, with gasoline picking up a little bit. We've got student debt payments coming in. We know that real disposable income growth is going to be slower. And we've got this excess savings story coming off before you think about the shutdown. So Q4 looks difficult to us. And I think once we start seeing that more negative data coming through, if we get it printed, then we're going to start to see a readjustment come through that actually it isn't quite as resilient as all of that. But I think the market reaction to date has been, yeah, we've seen this resilient economy.
Jamie Dimon's comments about a potential 7% interest rate did not speak to an incredible strength. It spoke to stagflation. It spoke to this idea that the labor market is imbalanced, there aren't enough workers, and people are charging, they want to get paid more. It's about the fact that workers at a lot of these smaller businesses are seeing costs all around them increase, and so they have to keep up, and business managers have to charge higher prices to keep up with that. Why is that not the reality, that any kind of softening won't actually decrease inflation materially the way that a lot of people were expecting?
And I think it will. I mean, our forecasts are, and if you look at the data, you are seeing a softening come through in inflation. And I think to Tom's point, yeah, you can create a scenario where you have to sort of see this sort of stranglehold on the economy. It just doesn't look necessary. In fact, what we seem to be seeing is a much more benign disinflation than many had thought. Unemployment's still at 3.8%, right? But you're starting to see this coming off. And we think that continues. But it does need a period of below-trend growth, we think, which the Fed is aiming for, and then you go back to this sort of immaculate soft landing, which, you know, given what we're seeing come through from the investment side of the economy, we might just get. But I don't think it's going to be painless. I think the fourth quarter we still see a contraction. We then see a relatively soft, particularly from the consumer, first half of next year. That being the case, that disinflation, I think, comes through. And I think the Fed acknowledges this. Listening to Powell a week or so ago, you know, he wasn't saying we're definitely moving higher. It was a 12-7 vote between the committee as to whether or not another one came through. And all Powell could say every time he was asked is, we're data dependent. The Fed's retaining its optionality. It's not saying we're definitively moving higher, and it's certainly not saying 7%.
What does AXA see from clients, institutional clients, what you see just in general around the world in use of cash? What are people actually doing with the current yield on cash? So
the current yield on cash means that people are very happy with cash in a way that we've not seen for quite some time. Short duration funds are doing very well. People are a little bit uncertain. There has been a lot of uncertainty about taking that duration longer. But that's starting to fade. There's now a mood that with longer term yields at these rates, that they offer good value again. That not only are you getting a return.
So you're seeing a duration migration.
Yeah, starting to see that come through. And the duration now offers you some of the hedge against some of the risks that are still out there to the equity side, which has just not been present in long-term bonds.
Away from your remit, but nevertheless, it's in the zeitgeist this morning, folks. I really can't say that enough. Is the speculative bet, given the uproar that Lisa's beautifully framed this morning, and that is, are we setting ourselves up for the mother of all 2023 short squeezes?
Well, I think we are going to get a real...
And bond squeezes? I don't mean just the equity market.
Yeah, no, I mean, we think that the peak has been reached in yields. We think that there is a risk of quite a meaningful adjustment in risk as we go through the fourth quarter, because I think different from the start of the year when markets thought, you know, there is a good chance of a recession and therefore the Fed's going to cut aggressively and that eased financial conditions, you've now got this opposite narrative coming through, which is the economy is really resilient. Longer-term rates are going to stay high for a long period of time, and against that backdrop, it's more difficult for companies, and we're starting to see that coming through even in S&P pricing, but in risk more generally. So that tightening in financial conditions, I think, is starting, and if we start to see economic data soften over the fourth quarter, which we think we will, I think markets are going to find it difficult to differentiate that between a genuine start to recession story.
How much conviction do you have in that, in the sort of load the boat and 10-year yields?
We think that, well, we have a reasonable amount of conviction in that, but we do see risks on both sides. I mean, we've just adjusted our view, given what we've seen over the last few quarters, particularly in terms of investment, that we don't think we're going to see a recession. We thought that we would see a mild recession. We now don't think that's the case. But the top-line indicators are still there for that, and yet we have to be mindful that, particularly with excess savings, there are also risks to the upside as well. So I think, for the first time in quite a while, we see risks both sides of our view, that actually we achieve a relatively modest pace of growth.
It is my job to be gloomy and to be perhaps a little bit skeptical of a lot of the optimism that Tom talks about. It is in my DNA, unfortunately, for me and probably for people who listen to me. But there is a question. People have to sit on set with me. But there is a question as I look at all of these moves, and Tom was pointing to the dollar and some of the moonshots that we've seen over the past couple of days. I look at yields as well. When does something break? Are you seeing any vulnerabilities in particular sectors that are reaching fissure points in a material way?
No, I mean, we've not identified those fissure points, but, it's like Larry Summers said a little while ago, against a backdrop of these rising rates, you are going to get problems coming through. We've seen it in the UK a little while back. We saw SVB. They've not been sort of systemic. We don't expect a systemic risk, but there will be people that are coming under pressure. Leveraged loans, small businesses we talked about a little bit earlier. All of these are not insulated from the significant tightening that's come through, and that puts pressure on financial and non-financial firms. And it's likely that somewhere something blows up, but identifying those ahead of time is always difficult.
We've made double-digit, somebody told me, in 60-40, 60% stocks, 40% bonds. We had a nice recovery off a bloody 18 months. Can you reaffirm 60-40, or do you have to do something creative at AXA?
We have a range of funds at AXA which aren't just based on 60-40. Our global thematic funds have been some of the sort of.
But is there efficacy in 60-40 out 36 months?
It's not something that we sort of put much weight on particularly.
Okay. David Page, thank you for the brief. With AXA Investment Managers, working with Gilles Moak, among others, out of Paris, New York, and London. Lisa, one of the things that we haven't talked about enough today is futures at -20, and the equity market did not have this weight to the tape yesterday before the Hail Mary recovery late in the day.
Do we trust these moves? Is this sort of a move?
Here we go.
In seriousness, there's just no conviction right now in markets. Let's be honest. The only conviction that we've had has been short bonds, right? Has been this idea of yields going higher, and are we hitting that breaking point? People say they're going to buy, and then yields keep going up, which is the reason why I'm curious about that 1 p.m. auction today of 2-year notes.
Post-pandemic, in the media roulette wheel, I'm as guilty. Farrow's not guilty. But you and I are guilty.
He's
Farrow's
never
not
guilty.
He's never guilty. Is the panic over a correction, a bear market, or something worse? Let us recapitulate the drawdown banner from yesterday. One of our interns redid it for us as well. There it is, drawdown. We had Biden up there on the UAW strike. We'll get to that. Drawdown, SPX, -6%, down -5%. NASDAQ, 100, the beautiful 7, cratering, I say, -7%. In the old days, these are, like Laidler said, October of '87, the VIX was 150. We're nowhere near sweat. We're nowhere near blood on the streets.
It's interesting that people are focused on the downturn and the downdraft, on the, correction that you want to talk about, which is barely a correction or not a correction. It's because it's so rare. We have not seen these stocks go down, and I think that's important. And that's something that people talk about. Citigroup analysts coming out today and saying that there are a pretty big amount of short positions being put on the NASDAQ, and yet again,
I would watch that.
We don't see it, not yet.
Yeah, the short squeeze, I'm not going to predict that, but let's remember that's a short-term phenomenon. We're also looking at the long-term phenomenon. Looking at the oil market with our great team and Javier Blas is Will Kennedy. He will join us here. It's a quiescent oil, Brent crude, $92, $93 a barrel. What's next? Futures at -21. The real yield, 2.15%. Wow. Bloomberg surveillance. Good morning.
We're going to continue to see volatility in the $80 to $100 oil price environment right now. But I think the higher price is a reality that we're going to have to deal with as we think about our investments and we think about the energy needs of the globe.
Is $100 a barrel now a different $100 a barrel? That's one of the arch calls, the zeitgeist of the end of September. The Bramo cam catches Lisa saying yes. Douglas Lawler, Continental Resources CEO with Alex Steele, talking up there. You're nodding your head. You're going, this time it's different.
I'm not going to weigh in one way or another. The argument is that if you see inflation take prices up more generally of everything, then this is an economy that can withstand a $100 barrel of oil in a different way than, say, 10 years ago when $100 had a very different buying power. And I think that is the argument of the likes of Christian Malik over at JP Morgan.
You know, it's great here. You know, I was in London. I was in the food court. You know, they have real food over there. We don't. Protein and, you know, strange things like that. And I'm up against a porridge. You know, they have
actual porridge.
We have Quaker Oats, like little cutesy bags full of sugar and chemicals, and they have vats of porridge brought in from Claridge's.
Oh, yeah.
It's great. So I'm standing there. Will Kennedy walks up to me, whispers in my ear, "Cocoa." He goes, "Cocoa." I go, "I don't know where it is in the food court." He goes, "No, stay long cocoa," because that's what's happening in the commodity world as well. With futures at -19, Dow futures -130. I want to really reemphasize today off of oil, $93 a barrel, that it is bonds and the litmus paper of foreign exchange that we're looking at. I've got a 106 DXY, yen out at 149. We could stop the show here, Morning Drive Time America, and have people drive off the road on radio talking about yen. It matters, but it's distant. Lisa, you said you're looking at a sub 106 euro. Are we on parity watch? I mean, it's just simple.
Well, people are saying that something has to happen to get to parity, but still, the moves have been notable. The fact that we've dropped below 106. This is not a boring moment in the FX market.
Well, we're not seeing that. You wonder about trends there as we see a trend in DXY. Will Kennedy is Senior Managing Editor, Trend Analysis here at Bloomberg, and he's got commodities trending like cocoa, like sugar, and a few others as well. Will, those are softs. Is oil trending like cocoa? Is oil technically like in place to drive ever higher?
A lot of people certainly think so. Mr. Lawler certainly thinks so, based on the interview that we had with him there. We've taken a bit of a breather, clearly. We're back down, back from the 95 that we're at, but I think a lot of people believe that that trend is still in place to take a run at $100 a barrel, and that's driven by the continuing tight grip that Saudi Arabia and Russia is keeping on global supply and what looks like fairly robust demand around the world, and a realization that fossil fuel demand continues to grow and that a reopened economy is seeing record demand for oil.
You know, what a great conversations, Will, we had, including with you, and an appearance by Javier Blas on surveillance was treasured in London. But, Will, I look here at the arch question, is this time different? Within all of our reporting, how is this belief in $100 a barrel different from the last time around?
I think one key difference, Tom, is that $100 today is a very different to $100 in the past, and that if you talk to people in the Middle East, they would tell you that $100 is a pretty fair price for their oil, given how much the global price level has risen since. I think one of the ways to see this situation geopolitically is that Saudi Arabia and the other OPEC producers want what they see as a fair price for their barrels. They see the purchasing power of their dollars have fallen away, hence this drive to get oil higher. So I think that's one way in which it's different. The other way in which it's different, of course, is that, you know, there are ways in which demand can be substituted. And one of the key things that people will be looking for as we go forward is, if we do get to 100 or more, what does that do to demand? What does that do to demand for to EVs? What does that do to demand for air travel as jet fuel prices rise? And I think people are looking for that spot where demand destruction starts to kick in.
And well, one thing that we heard from Oklahoma City in the conference that Alex Dio was at yesterday is that it's not going to happen at $100 a barrel, and people are seeing renewed buying. It certainly isn't happening at $90 a barrel. One of the interviews was with Harold Hamm, the billionaire who oversees Continental Resources, and he said that oil prices will go to $150 a barrel if the government doesn't support new drilling. Is this just a self-serving comment, or is this true?
Mr. Hamm likes to say provocative things, I think I would say. It's not entirely clear to me what the government is doing to drive prices to $150 a barrel. Despite the rhetoric coming into the last election, the Biden administration hasn't done an awful lot to slow down shale drilling. What, in fact, has probably slowed down shale drilling is two things. One, Mr. Hamm's investors, those people who invest in the shale industry in Wall Street, are demanding an emphasis on cash over volume, and that's been a big sea change for the shale industry. It's not about growing your volume, it's about returning cash, making profits. That's the first thing. And second, for many shale producers, and I don't necessarily include Continental in this, they have drilled the best bits of their holdings, and that, the days of really, really rapid growth are harder to achieve. There is a secular slowdown in the shale industry. And I think most people, if they were looking at it objectively, saying those are the factors holding back shale demand rather than the tight grip of government regulation. I think there's a lot of rhetoric in what he says.
And you could take the other side of this, especially because we heard David Solomon from Goldman Sachs yesterday at that conference talking about how it would be folly to move away from financing some of these fossil fuel companies, that you still need to invest in oil and gas in a more material way. And we've heard this from others too. Basically, it's a reality check. We're still using some of these materials. So if that's the feeling from banks, won't some of these projects be financed more now than 2 years ago? Isn't there more of a sense that there is actually open financing available to some of these companies?
I think that was the really important comment yesterday, actually, that you had the chairman of one of America's largest banks saying clearly that they don't want to retreat from this industry, that this industry remains an important part of the American economy, and the bank will be there for them. And I think this is a big shift in approach from perhaps a couple of years ago, where CEOs like Mr. Solomon would have been a little bit more reluctant to say that directly. Of course, he's in their backyard and it's the place to say that. But the fact that he went there at all to say it, I think is very interesting. And clearly, there are people still willing to finance the oil industry.
What's the biggest concern for you right now, Will? A barrel of oil in the U.S. or natural gas over in Europe, where we saw prices really increase. We've seen a real disruption from some of the strikes. And we're heading into a rainy, colder season, as we learned when we were over in London.
Yes, I think there are clear risks for both markets, actually, and that we will want to keep a very, very close eye on the weather and see how cold this winter gets. Clearly, Europe was saved last year by a pretty mild winter. But if we look at gas, yes, we're in a good position. The strike didn't happen in Australia. Stockpiles are very full in Europe, but it remains a very tight market, and a sustained period of cold war a good thing. And then again, if you look at diesel, at fuel, the refining industry worldwide is stretched, and we're constrained by how much fuel we can make. You see Russia ban diesel exports for a short while. We'll see how long exactly. That tells you that governments are worried about getting enough fuel to their customers. So a cold winter could make for a very interesting energy market.
Will Kennedy, thank you so much for the brief from London there on the hydrocarbons, looking at West Texas Intermediate back under 90, 89.02, Brent crude under $93 a barrel. Lisa, what are you looking at on the screen? Equities, bonds, currencies, commodities.
Well, I'm actually thinking about what Will Kennedy was saying there, that basically if you have Goldman Sachs making the trip out to Oklahoma City, if you have these financiers basically saying we are going to keep financing you, we are committed to doing that, well, then does that increase investment at a time where people are writing it off and actually increase production down the line? I mean, really, some of the nuances here that go against some of the common belief that investing in fossil fuels is dead and that it's obsolete, maybe not so fast.
I used to be in seminars, and upstream, downstream, my eyes would glaze over because I couldn't figure out what was up and what was down. But the answer is, there's a belief here, folks, and Bloomberg's done great work on this, even Bloomberg Green, on underinvestment in hydrocarbons. And you've got to believe with price and a sustained Saudi belief in $100 a barrel that investment just has to come back, including from a Chinese. That's what's different from the 80s.
And how much does that go against what we were hearing from Christian Malik of JP Morgan of this chronic underinvestment? And you can make an argument, well, it takes a lot of investment to really catch up over time. But still, on the margins, you're seeing people go into energy debt, go into energy equities in a way that they haven't for decades. And that, to me, is a big shift.
Your family drive a VW diesel Rabbit? That was a car.
65 Oldsmobile, cross country.
That was a car. People think it was like the yellow Oldsmobile GTO or whatever with the little wires in the hood. No. VW Diesel Rabbit was the cool car.
We had the windows down.
Yeah.
We had that little triangular window that you push out.
We didn't have a radio in it, so we couldn't listen to Bloomberg Surveillance. Good morning. On radio, on television.
U.S. growth both accelerating and surprising to the upside. That's something that's going to change.
The U.S. economy near term will probably be slowing down.
When I look at the bond market, it's pricing in a slowdown. When I look at the equity market, it's not.
What people have been doing all year, which has confused me, is sold bonds but said that they liked them.
Right now, we're still in the annoyance phase of inflation. That's why we think it will persist.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Good morning, everyone. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowitz, and Tom Keene. Thrilled you're with us on radio, on television. Right there is what we're about. Katie Kaminsky and Eric Davis yesterday, each separately, equities and bonds, looking for price down, yield up. Bramo loved Monday, not so much in love with Tuesday. But Lisa, I mean, the toxic stew or brew of the last 48 hours is something.
Yesterday was a tipping point moment where we saw yields climb to levels that people didn't think plausible. And they basically were all saying that we had seen the peak about 6 months ago, and here we were reaching new post-2007 peaks in the 10-year yield. And today we're seeing a little bit of a bounce back, but not with conviction. And that raises a question, can we live with these rates? Why are risk assets holding in as much as they are? Yes, you're seeing a bit of softness today. And are we entering a new regime that looks unfamiliar to anything that we have seen over the past 20 years?
And I would stagger the data dependency. Yesterday, the 30-year bank rate, I don't have the mortgage yet, but 7.75%. That's an American statistic for our global audience that we're all, it's like the Dow Jones industrial average, 34,149. It's just a heritage statistic for our listeners and viewers. Can you imagine that breaking out and not going where Jamie Dimon's blathering on today, but the 30-year bank rate at 7.98%?
And what if that stays there, right? I mean, this is the issue. What if it stays there for the next 10 years or the next 5 years, the next 3 years, and people actually have to start moving and you actually get price discovery in the existing home sales that have fallen off a cliff? Is that when you start to see things repricing, or can we deal with this? Are we adapting and adjusting? Are people basically managing through a world that just looks different?
But we're data dependent. On the 26th of September, Michael McKee, 9 a.m. this morning, Case-Shiller. I'm sorry, I'm not going to call it S&P CoreLogic. Carl Case, Robert Shiller. That's the way it is. Case-Shiller, we're going to get a negative statistic year over year. New home sales, who knows what we'll see. But that becomes the data path into jobs October in inflation if we don't get the dreaded shutdown.
Well, if you start to get disinflation in housing, that could be positive, right? If you get the idea of prices going down at a time where affordability is at a record low for the average American, that might be what the Fed wants. The shocking aspect is it hasn't been deeper. We haven't seen that 20% correction in home prices that you'd expect if you have a tripling in terms of mortgage rates. At this point, really, the issue is we don't understand the long and variable lags.
Let me get through the data, and we got to sell a book here quickly for the hour. Futures were worse earlier, negative 18 right now. That's down 0.4%. SPX down 0.5% as well. The VIX 17.42 in from that 18 level yesterday. Quickly in the yield space, 4.50 after a higher yield. On the 10-year, real yield 2.14%. We got out to 216, 217. Will Kennedy tells me oil stable. Right, Will. Dollar 106 DXY, yen 149-ish, rounded up. I'm going for the gloom here, folks. It's a Bramo data check as well. Coming up in this hour, Jonathan Ferro in conversation. They sold the movie rights to this book already. It's amazing. That was because of Gordon Brown. The Prime Minister of the United Kingdom, Gordon Brown, writing with Mohammed El-Arian and the laureate Michael Spence, Permacrisis. And this is a primal scream about the technology, think Spence, buttressed up against the game theory, think El Arian, many T decisions in the book, and then Gordon Brown about the politics of how we extract ourselves from the emotion of the time. John Farrow with that later in the hour from London. We need a brief.
Tremendous conversation, which I'm looking forward to. Today, we do get economic data, including the S&P CoreLogic Case-Shiller housing price data that comes out at 9:45 a.m., as well as new home sales that come out shortly after, and Conference Board consumer confidence. I am curious to see how much that downdraft in valuations accelerates. Do we see an actual correction in a market that is not a market because houses are not moving and in the existing home space? The new home sales, yes.
Yeah, okay, but my tie-in is what to rents? How does this come over to rents? And there is rental disinflation across America. You and I don't know that in New York. But come on, rents are disinflating.
They are disinflating. Some nuances around that. All really important things to watch because they feed so heavily into the Fed's inflation gauges. Then at noon, we do see President Biden joining the picket line with the UAW workers in Wayne County, Michigan, which is going to be really a pivotal moment, the first time in more than 100 years that a sitting president has done that.
We don't want to stop the show for my thoughts on this, but just, would Harry Truman do this? What Truman took from the unions, I just don't think so. Truman is after FDR.
Thank you. I appreciate that. Excuse me, I will get it out. The juxtaposition between President Biden and then the former President Trump coming the following day will be interesting. And then at 1:30 p.m. Eastern, Fed Governor Michelle Bowman speaking after yesterday we heard from Neil Kashkari saying one more hike for the remainder of this year. The risk to the upside when it comes to inflation, Tom.
Yeah, why don't you bring in Emily Rowland? Because, I was talking with Emily early in the season and, like the third week of April, I said it's over. And she said, oh no, those Red Sox will come back. And, she and I really aren't on speaking terms.
Okay, I'll let you guys work it out.
The last place Boston Red Sox, they took the damn John Hancock sign down. What was that about?
Emily, I'll let you work it out with him in a little bit, but I do want to start. Emily Rowland, Co-Chief Investment Strategist at John Hancock Investment Management. I'm nailing everything this morning. I'm curious, your perspective, when we look at some of these yields, are they sustainable? Does this look logical that we could see a 10-year yield at 4.5% and heading north?
Yeah, it's unbelievable, Lisa, the backup that we've seen in yields, and it's seemingly on no news at all. Last Friday, we were kind of combing the headlines trying to figure out why the 10-year Treasury yield had backed up 10 basis points in a day, and it was really no news, no economic data. This feels like a move that's very much driven on sentiment, very much driven on technicals. Maybe it's liquidity fears, maybe it's supply fears. But we see this cycle as being a lot more relevant. In fact, if you look at this backup in yields against the macro backdrop, it doesn't really make a ton of sense. You looked at headline CPI at 9%. Yields were lower then. I look back at 2021, manufacturing PMIs were 63 in the United States, and 10-year Treasury yields had a 1 handle on them. So what we've seen is that yields have moved higher, even in the face of this sluggish economic growth, this decelerating economic growth, and this moderation in inflation. You guys have talked a lot about the housing market this morning. We're seeing disinflation in housing, and in fact, housing prices on a real basis, you talk about real-time measures of rent, are probably about flat year to date. So it's very strange to us to see yields backing up to this extent.
Emily, the difference between you and me is in my youth, the Red Sox never, ever, ever, ever won. They were always disappointing. And you, of course, know all those glory years. Now, here we are, the end of September. We're both crushed by the last place Boston Red Sox. And my question is, like the Red Sox, is all this gloom and tension in the market, is it seasonal? Is it just the month we're in, the week we're in?
Yeah, September is a notoriously difficult month for markets. We try to look past that. There's all sorts of data out there right now suggesting, hey, when September's bad, then we're going into a positive time for seasonals. All of these are sort of shorter term gyrations in the market. I do think that it's possible that we'll see some volatility. We're going to start to hear more from corporations when earnings season picks up next month. It's just hard to see what the positive catalyst is for markets today in an environment, again, where the economic data is slowing. The cost of capital is incredibly elevated right now.
Right.
You know, obviously it's hurting consumers. There's major headwinds. You guys have talked a lot about this morning, everything from oil prices rising, which acts as a tax on the U.S. consumer. We're seeing mortgage rates approaching 8%. Auto loans are the most unaffordable in U.S. history. Right now, the labor market's looking fine, but eventually the consumer is going to start to do the math when they look at the restrictive cost of borrowing and potentially pull away here.
You beautifully explained that. So I got a cost of capital issue with a real yield up, new. A lot of people have never experienced this. Seriously, folks. And so that comes down to what I call the choice set. I'm talking, you know, Eulerian here, game theory, and that by definition with an elevated real yield, don't I have fewer choices in my set of opportunities?
Absolutely. And what we're really trying to do here is minimize our exposure to companies that need to issue debt or equity in this market. We look at unprofitable companies, growth at any price companies. You know, when you go way down in market cap, for example, the Russell 2000, 45% of it's comprised of companies that don't make money. That's not where we want to be in this cycle. One thing that we're watching really closely is we're finally seeing defensive equities perk up. And you can give me a hard time on this one, Tom, because I've been talking about defensive equities since the spring, and I've been wrong. You know, who needs defensive stocks when you can, you know, own tech stocks that are up 40%? But I think that, yeah, right. I think the baton can be passed there. And you look at the ratio of defensive equities to cyclicals, it's perking up. And I think these companies can get a bid as we head into this more challenging macro backdrop to close out the year here.
And what's great about this, Lisa, down Boylston Street in Massachusetts, where arguably this is where mutual funds were invented, in the ether this morning are convertible bonds. Well, yields are so out of whack that the new stock is a 5% convertible bond.
And any kind of bond, actually, which is what we heard from Jim Zelter over from Apollo. But I am curious, Emily, one of the challenges to conservative stocks is it's unclear what that means. A lot of people are saying that is big tech. How do you define it?
Well, we still do like tech. And again, it's your classic S&P 500 tech sector, not your growth at any price tech, because tech is the poster child for quality. These are companies with awesome balance sheets, tons of cash on their balance sheet, a limited need to tap the capital markets in order to grow. But we all know that tech has gotten expensive. And so we want to think about using technology stocks to protect portfolios from solvency risk, but we also want to protect stocks from valuation risk. So I think you need to comb through the value side of the house. We don't love everything value. I think you need to be selective here. Sectors like healthcare, which have a 20% ROE, they're trading at a 10% discount to the market. They've been left in the dust. I think these are all areas that can really do some more heavy lifting in portfolios.
Well, Emily, fall out of old John Hancock up in Boston, wander over to Trinity Church, sit on the front stairs there, looking at the Copley Square pigeons, and pray for a shortstop. Emily Rowland, thank you so much. In Boston, beleaguered Boston, with John Hancock this morning. You know, that was a brilliant conversation about, and at least, you know, I bust your chops all the time, but you can't go up without fear. Cardinal rule. We're going to have to discuss that through the coming conversations. Later, John Farrell on Permacrisis. Good morning.
Right now, we're looking at S&P futures down about 0.5%, and you could see the NASDAQ futures lower by 0.6%. And Tom, as we look toward this, there is this issue of what does defensive mean? What does it mean to be cautious at a time where the rules have been flipped on their head? And I actually liked what you asked earlier this morning. Does 60-40 work in a year, in 2 years?
It's a brilliant question. Yeah. I mean, this is a really, really serious question. And of course, this comes off, and Lisa was way out front on this, folks. The Bloomberg Total Return Index is plural. Whatever you look at here, it's been an ugly 18 months. And that was the destruction of the certitude, the confidence of 60-40.
Katie Kamensky was talking about that yesterday. She was saying we're facing yet another year potentially of negative returns. And if you take a look at the the Bloomberg Aggregate Index of Bonds, you could see it's poised for a third straight year of negative returns. A third straight year for the defensive bet du jour, which is the reason why, actually, the dollar is the reason why it's become so interesting. We heard that from Ross Kostrich earlier this morning, that that's actually the main hedge. more than any bond.
And I take real issue with this. Lisa's expert at this, but everybody talks about the present and bonds. They never look back like in equities. And the answer is they've got to spread a strategy. You know the fancy lingo better than I do. The answer is price down, yield up, and we've had 18 months, 24 months price down.
And when will people start to care about that?
Retirees care right
now. Yeah, well,
fancy Wall Street pros maybe don't care, but I think Jim Caron at Morgan Stanley cares because he's listening to Mike Wilson. Mike Wilson of Morgan Stanley, 8 o'clock hour. In 30 minutes, John Farrell on Permacrisis.
If you're running a business today, you have no idea which direction Washington's going in tomorrow, and whatever direction it's going in tomorrow, it might change directions after the next election. Wow. That's a tremendous level of uncertainty. I think a potential government shutdown, actually just confirms that level of uncertainty. Wow. And that's a wet blanket on any business and a wet blanket on the economy.
A Business View, Neil Bradley, U.S. Chamber of Commerce Executive Vice President there. With a lot going on here, we're going to get to this in a moment. We really haven't touched on it with the markets today. Futures negative 22, the VIX 17.58, the 10-year yield 4.51%. Excuse me, all of this elevated in the last number of days. I'm watching a real yield 2.14%. And Lisa, let me run over. I'm doing this on the Bloomberg Professional Service in real time.
You get royalties every time
we can do that. I know I do. No, Mike lets me keep my job. 7.75%. We don't have a 30-year mortgage print today. And that's something that you think on Air Force 2 or 1 or whatever he takes. Maybe he'll drive the car to Detroit. But the president today, he's got to be focused on the housing market as he is on UAW as well.
The fact that people feel these higher rates as well as higher inflation. And he is going to be in Michigan. We haven't really been talking about that. We've been talking about the government shutdown, which feels imminent, the Senate plan. But Emery Hordern joining us now, Bloomberg Washington correspondent, really to answer a question that I have been unable to answer, which is, Anne-Marie, what is the political implication from President Biden going to Michigan? Is this being really well received, or is it being highly criticized?
Well, I think the president wants to make a political statement. He continuously says and ran a campaign that he is a boy from Scranton and he is the most pro-union president in modern American history. And as I said yesterday, he's now really putting his money where his mouth is by actually going to the picket line. The White House is really trumpeting this as the first president to do so in modern American history, maybe actually ever. The only really moment I can see as an individual putting their thumb on the scale for the labor union had to be the early 1900s with Teddy Roosevelt and the coal miners when he had them at the White House. So this is a big historical moment for this president, and the White House is touting it. Also, if you look at the polls, 1 in 6 Americans, Gallup did a lot of research in this in August, given the hot labor summer, but 1 in 6 Americans come from a union household, and about 70% of Americans support labor unions. So politically, I think the White House views this as very helpful for his reelection campaign next year. On top of that, the former president, Donald Trump, will be going on Wednesday. So he is able to go with an invitation from the UAW leader, Shawn Fain, not just showing up on his own accord, with an invitation from the UAW and what the White House is calling stand in solidarity with those union workers.
As you said, he sort of got political insurance because the other side is trying to make the same case. So it's not as if there is sort of an argument to be made of pro-business, support the profits of the big auto manufacturers. What is, though, the response from some of these auto manufacturers? Are they just being quiet and sitting there and watching this all unfold?
I think they've just been quiet. They understand the politics at play. They obviously want to also make sure that they can get these negotiations under wraps, right? This is the second week now we are seeing these protests and these strikes, and potentially the worry for them would be if they start to expand and they start to hit other plants. Ford, because it does seem like they're ahead of these negotiations with the UAW. The UAW decided actually not to expand in hitting some of those plants. I think they understand the politics of the moment. At the same time, the president has made pretty clear, and the White House continuously says, Karine Jean-Pierre was asked about this relentlessly yesterday, and she made clear that they are not trying to inject themselves in the negotiations. The president just wants to stand with workers. The president has said, he said so yesterday, that the workers are part of the reason why the auto industry was saved. And they took a lot of cuts over the years, and now they deserve to make some of that up.
Anne-Marie, you're always great at the history. You're taking it back to after World War I there in the trauma. I thought of Harry Truman, this is before my time, Harry Truman saying to the steel industry, we've got a war in Korea, you're not going on strike. He took over the steel industry. The Supreme Court said, no, Mr. President, you can't do that. This is April 8th of 1952. And what it was really about, Anne-Marie, was who's supporting business. Now, I don't want to get all Henry Cabot Lodge on you, but is there anybody in Washington supporting the automakers?
Well, here's the issue. There is support for the automakers, but it is politically unattainable to come out and say you do not want to see workers have higher wages.
Where have we lost the Chamber of Commerce vote?
I don't think they're not saying they don't support business. I think they are trying to walk a line that is that they are very pro-business, but at the same time, they want to make sure that workers are getting a fair wage. Republicans easily turn this around and say this is caused by the fact that these workers are asking for a 40% wage. I think they lowered it actually to 36 at this point. That is because of inflation, and they need to keep up with higher grocery bills. They need to keep up with gasoline prices. They need to keep up with higher rents, and they are putting it squarely back into that this is a problem of the Biden administration's own making.
Lisa, this is to me critical. This is not a Bloomberg surveillance topic. It'll be like 8 pages in the Atlantic or Bloomberg opinion or that. But this is Pelosi, Wall Street, Main Street. Who's supporting Wall Street anymore in America? Let me know. Right? Mitt Romney, and he's retiring.
I would take a step back and actually view this very much in an economics lens. And I'm curious what this means for wage inflation going forward. And Anne-Marie, the signal being sent when right now the discontent around the economic state of this country has to do with the fact that inflation is so high. It's forget about whether it's disinflating. People feel it when they go to the grocery store, et cetera, anything in their lives. So at what point, as a presidential candidate, do you have to come out in favor of higher wage increases just to keep up, which actually supports this idea of a more inflationary push for a longer period of time?
Well, the Barron's this morning has a great piece on how economically this could be a can of worms. And if you ask Jay Powell and the Fed if they enjoy this strike right now, the answer might actually be that this doesn't actually help with their Fed rate hike cycle. Because what can happen is, obviously, you want to see wages outpace inflation, but inflation is so high, and you have to see wages really outpace inflation. That's when you can have a cycle like we saw in the 1970s that is just unattainable right now. I don't think this administration is going to want to get into the weeds of any of that today. They are going to want to avoid the word inflation, and they are probably going to want to avoid the words EV transition, which is really also the bedrock and the tension with these discussions between the UAW and the big three. But that's what makes this moment in history and in the economics and politics so interesting, because not only is this a hot labor summer with the support of the most, as he self-described, most pro-union labor president, but also the fact that the Fed is actually trying to tamper down inflation.
Emery Horton, thank you so much. Greatly appreciate it. And, of course, balance of power driving this conversation forward, I believe, after the president visits Detroit and, as reported, visiting the picket line as well. I just wonder, Lisa, I look at the President Trump's phrase, Republicans in name only, and maybe there's Democrats in name only as well, but just the middle ground that says maybe politically we should stay out of industry warfare like the Supreme Court told Harry Truman a lifetime ago.
I was still thinking about what Anne-Marie said, where she said, the automakers understand the political posturing, and they're taking a step back. There is a difference between what you say and what you do, and the idea of expressing solidarity with workers who are angry about their wages not keeping up with inflation, about their wages not keeping up with profits, is a theme that you're seeing across parties. And what I find interesting about that is that laying a policy groundwork for wages to stay higher and keep going higher for a longer period of time. In other words, sort of making this inflation more entrenched.
Futures negative 19, the VIX 17.47. Yields, I guess it's sort of quieted down here before that 9 o'clock housing data. In 15 minutes, we are going to introduce to you worldwide, with the good work of John Farrow, a book that says, Lisa, we've just staggered from crisis to crisis. Ian Bremmer says of Brown, Ellerian, and Spence, vivid detail, permacrisis offers hope and good sense in equal measure.
I could use some of that. I think hope and good sense would be very welcome by a lot of people right now. I think that it's difficult when people are just trying to patch up the mistakes from the previous couple of years, and that seems to be where we've been.
What I love about this is these three guys have really differing skill sets. I mean, you know, you can pick a Venn diagram and put it over it and all that, but it's going to be an interesting conversation just about the technological overlay that we've had. We'll do that with John Farrow here in about 16 minutes. The S&P 500 down 0.4%. Bloomberg surveillance futures negative 16, worser earlier, worser than Monday with that equity Monday recovery that we saw, but a little bit of weight to the tape. VIX, not the 18 level, 17.33. NASDAQ down 0.4%. SPX, I'll get it right, down 0.4% as well, 4.49%. It's a calming market here this morning. We're going to get to a massive must-listen global Wall Street conversation here with Kathy Jones from Schwab here in a moment. Publishing, Ian Lingen publishes. He says he likes the skepticism out there, a la Kashkari, and the reaction to that. Torsten Slok Publishing moments ago at Apollo. Thank you, Jim Zeltner, for that conference in London. Was that cool?
That was very cool.
It was very, very cool. And Torsten notes that the cost of money is beginning to affect venture capital. And to me, Lisa, this is a huge deal, this permeation of the real yield, the new yield back to 06, 07. It's a whole new world after all.
Yeah, I mean, we were talking about Instacart and ARM coming out with IPOs, and the buried news was it was a fraction of what they were valued at a year or two ago. And oh yeah, the IPO price has actually gone down in the real market after the IPO.
It's FX Tuesday, 106 on Euro, exactly 106.00. I noticed sterling under a 122. Farrell may not come home. 121.88, weaker sterling over the last number of days. Swiss franc doesn't give me love. I do not get stronger Swiss franc off that, which is of note. And we've barely touched. I got a yen, 148.88, rounded up 149. Yen at a 150 gives pause worldwide. We're going to do under surveillance quickly here because we have an important global Wall Street guest.
All right, well, we're watching this. President Biden joining the picket line in support of striking UAW workers. He's heading to Detroit around 12 noon. Meanwhile, tensions between union workers and Ford have been ramping back up because the company is halting production on a $3.5 billion battery plant in Michigan, with scrutiny coming based on Chinese backing for that factory. This keeps percolating out. Tom, to me, the most interesting aspect of this whole story is how it really supports wages going up and how it gets in the crosshairs of so many different debates and is so messy. It is so hard to sort of parse through the strains of trying to support business, trying to separate away from China, and also trying to make sure workers get fully compensated.
I was reading a vignette, I'll give credit to The Economist, on Europe and China in EVs. And to me, there's a massive OBE. There's just a massive overcome by events here to this manufacturing race on new technology.
Okay, I'm going to quickly move on and get to the Senate nearing a bipartisan deal on a short-term spending measure which could avoid some sort of government shutdown. Bloomberg reporting the deal would extend funding for 4 to 6 weeks after the October 1st deadline, so we could do this all again. And meanwhile, the focus really is on House Speaker Kevin McCarthy and his future if this does pass the Senate, because then he has to decide whether he brings it to a vote in front of a House bitterly divided against some of the protests of some of his more hard-leaning constituents, and could this lead to his getting a loss of confidence vote at a time where there's nobody who could really take his place?
Stay with Bloomberg surveillance, folks. In Surveillance Shutdown Central, we have a team of people led by Michael McKee and Anne-Marie Horton to look at this.
We also have a team.
I do read the blurb there. Shutdown Central.
Shutdown Central.
Yeah, I want a countdown clock.
Yeah,
please.
Yeah, it's going to be just a perpetual, ongoing one. U.S. billionaire Citadel founder Ken Griffin. This is interesting. It's sort of the takeover, U.S. takeover of London. We've been talking about London football teams. Well, Ken Griffin is reportedly backing a group to take over the UK's Telegraph media. The auction for the publisher of conservative titles such as The Telegraph and The Spectator is expected to garner the attention of the owners of the Daily Mail as well. So we talk about all of these billionaires and hedge fund managers and private equity fund managers going into London football teams. Now they're getting into other forms of entertainment as well.
We don't need to run this as a clinic, but we talked about this in London, and that here all the media is like, we don't have an opinion, but they do. And they're like, we have an opinion, buy our newspaper. It's much more vibrant over there.
John Farrow actually explained to me the genesis of that. And it actually makes a lot of sense, which is there are all these dukes and lords that own the papers and had a point of view. And then it was just a stated point of view, whereas it was a sort of different generation of news in the United States.
Yeah, and Mr. Murdoch retiring in tabloids, and not that I would ever read a British tabloid, and I couldn't get.
How many did you read?
I couldn't get past page 3. Continue if you would, please.
That's all I got.
Okay, joining us now, Kathy Jones, Chief Fixed Income Strategist here on higher yields, on the real yield. I'm sorry, even at Schwab, Lisa, it's been an adjustment.
Yeah, I mean, honestly, right now, people are looking at these yields and saying, can they last? And you were even saying yesterday, as you looked at them, why? So why?
Yeah, I do think that we are adjusting to this new world where we have a positive term premium and we have a stronger growth outlook and certainly, higher for longer yields. The question is, what is the end point of all that? And so when we look at it, what we say is, well, the Fed might hold here for a while, but it's very difficult to see why they'd want to go a lot higher from here. So inflation is falling. Get a couple of more 0.2% month-over-month prints in PCE, and we'll be at 2.25 on core PCE. So we're almost there on inflation. The economy is slowing down. The housing market is basically frozen. You've got risks in the commercial real estate market that could spread back into banking. I mean, there's a lot of indicators here to suggest that they've done enough. So I'm curious to understand why some of the Fed members are still talking about raising rates even further.
Partly because the economic data keeps surprising to the upside. It's part of the reason why we keep hearing from different CEOs, Jamie Dimon, David Solomon, talking about resilience. And they're seeing it. They would see it first if they were seeing it really start to crack. Consumers are still able to spend, albeit not at the levels they previously were. So at what point do you lean into that and say, no, actually, maybe it's a screaming buy if you take a 10-year yield at 4.5% and you're willing to clip the coupon for the next 10 years. But are you really going to see that appreciation with some sort of massive decline in yield, increase in price that people were previously expecting?
Yeah, I think that we will see a decline in yield. Obviously, we're not going back to 0 or 1% or 2% or whatever, but I do think we'll see a decline in yield. So consumers are spending, but they're filing for bankruptcy. That's kind of the two-sided issue here. We're seeing a lot of delinquencies on credit cards, on auto loans. We're seeing defaults in the corporate sector. The speculative default rate is starting to pick up. I mean, there's a lot of evidence that higher rates are biting. It takes time to work its way through. The question is, does the Fed really want to send it over the edge? Or do they want to try for this soft landing? But, we think there's value in fixed income. You don't have to go all the way to 10s, but we think there's plenty of value in just clipping the coupon here. I mean, you look at the ag, you can, look at positive returns going forward because you've got a higher coupon and you don't have that much duration risk.
Okay, bring up the chart you just put up there. Amy, you nailed it with that 10-year chart. On radio, folks, it's just the 10-year chart. And the yield here, I'm going to get a little fancy here with Kathy Jones because she's a fancy person. I have nice log convexity. I have a beautiful 2-standard deviation trend and a higher yield. I've got elegancy on my Kleinman moving averages. I have a trend in place. How do you know when the yield turns and goes lower? I don't see that here. I see higher 10-year yield.
Oh, you're right. I mean, trying to pick the peak is really, really hard. It is in every cycle, and this cycle has been, particularly unusual dynamics because of the pandemic and the fiscal stimulus and all the special things that have happened.
But I have an
globally.
inertial force in the yield space to higher yields. How do I respond to that? Do I stay wicked short term, money market fund, cash, and that? Or am I brave, fall on a knife, and dive in here, or dollar cost average into it?
Yeah, we don't fall on knives typically. That's usually not our
Liz Ann
advice.
Saunders does that. Yeah, it's equity.
But we leave that for the equity folks. They can try that. We're dollar cost averaging in. So, we're looking at the ag with a duration of 6 and a yield of 5 1/4. And so mimicking something in that space, having a barbell perhaps, to do that, because you do get a lot in cash. You do get a lot in the short end, but you don't want to ride the cycle up and down because you're not getting any of the benefits, and you want to lock in some of the income. I mean, this is a huge opportunity for people investing for income right now. We haven't had this in 15, 20 years.
The concern that some people have is that bond vigilantes are getting a little bit stronger, and there are many more of them, and there are many fewer of the international buyers that might step in, say from Japan. How do you respond to that? Are you seeing the mix of buyers change and become more aggressive in their demands?
We're still seeing foreign inflows are pretty attractive, have pretty steady. So it's hard to parse the numbers because of the way they're reported through different agencies, but foreign investment's still pretty strong. So not too worried about that. I think a lot of it is the Fed's pulling back in QT, right? The Fed was our big backstop. And now the Fed's not buying, the Fed's allowing to roll off. And I think that that's one of the drivers of this, this last leg up here, is you just don't have them stepping in. And that's going to be a factor. That's going to keep rates higher than they would otherwise have been.
Kathy, I'm asking for a friend, folks. The Austrian 97 year, I've enjoyed from a 134, I bought it just below that, like 131, to 36. I'm down 72% on a 97-year piece of paper. And on a stochastic basis again, how do you know when that's going to reverse and be the distressed debt buy of all time? When do you go long Austria?
Tom, I wish I had the answer to that. I think that you're going to...
But on a technical basis, we haven't seen this in 17 years.
Right.
I mean, this is, Lisa has no memory of this. What percentage of Wall Street has no memory of going, okay, when do I go long Austria? That question hasn't been asked for 17 years.
Yeah, when you go long, super long duration, I think you're going to have to wait for a pivotal moment such as a big recession or some sort of crisis.
Kathy, that was such a diplomatic way of answering a question where Tom is basically like, please, let me offload my Austrian piece, finally cash out. That's essentially what you're saying.
Yeah, no, it's not potentially what I'm saying. Folks, this is the dumbest investment I've ever made. I mean, I'm not kidding here.
It.
But Lisa, this brings up what Kathy and Liz Ann have to deal with every day. These are markets that what percentage of the public in their adult lives have never even listen to this surveillance dialogue.
And I'll take that a step further. The concept of distressed debt investing probably wasn't thinking about sovereign debt from top-rated governments, and suddenly we are thinking about top-rated debt from sovereign governments because that's the kind of yield that you're getting.
Kathy Jones, thank you for briefing me on the Austrian piece. Futures improve off that conversation. We were negative 23, now negative 15. The VIX 17.23. Bitcoin, Matt Miller says, why don't you people quote Bitcoin? 26,247. It'll be interesting to see. The Standard & Poor's 500 down 0.4%.
Coming up, we are going to hear from the perma-crisis, how to plan for a different and better world, the conversation that our colleague had with the likes of Mohamed El-Erian, Michael Spence, as well as Gordon Brown. I'm very curious to hear just some of the prescriptions and some of the angst that they have as they try to grapple with what the new norm is.
And what's great about this, and we're going to get to the piece here, it's going to be really quite interesting. You got a former rugby player. He got really hurt in high school and prep school. Gordon Brown really got hammered playing rugby. But he's like a Labor Party from another time and place, the political angst about what we do. Spence, who invented graduate education in America at Stanford, has a beautiful understanding of what's called asymmetric information, the things we can't see within a system. And then you've got the game theory of El-Erian and T-decision. So it's this toxic brew of 3 people. They went to Spielberg with this book, and Spielberg said, we can greenlight this.
Oh, yeah.
Yeah,
I would watch it. Are you kidding? It's got my name written all over it. I will say.
Permacrisis.
It's so
Memorial
tricky
Day.
to figure out how to model the unmodelable, right? I mean, when you think about it, my father's a mathematician, and he once said to me,
My deepest sympathies.
yes, well, I hear that. But he said to me once, in economics, you can create the most perfect model, but the parameters will be wrong. And that's kind of where we are right now.
That's Spence 101.
And that's where we are right now.
Spence's famous essay, I'm guessing 2010, on the certitude of all this regulatory solution. And he said there are things you can't see. And that's what you're going to hear. John Ferro in London in conversation with Brown, El-Erian, and Spence. Coming up as well on your Federal Reserve, the Fed put, Julia Coronado, macro policy, perspective. Stay with us. Futures at -15. A treat for Bloomberg surveillance. Our Jonathan Ferro staying in London in conversation with the former Prime Minister of the United Kingdom, Gordon Brown, Mohammed El-Erian of the University of Cambridge, and the Nobel Prize-winning economist Michael Spence of New York University. The book is Permacrisis, A Plan to Fix a Fractured World. Brown, El-Erian, and Spence on AI and crises to manage in the future. Here is Professor Spence.
When Gen AI came along, and I saw its sort of multi-domain capability, the fact that you can use it with no technical training, just a little bit of practice, creating prompts, and its applicability pretty much everywhere. I thought, even though it's early days, and we're in a period of exploration and experimentation, I think it's a reasonable forecast that this tool is an important part of a future productivity surge, and if it comes, it'll make it a lot easier to do inclusive growth patterns because it won't be a zero-sum game. It'll be easier to invest multi-trillions of dollars in the energy transition. It's going to be terribly difficult to get that done with fiscal space declining, the rising debt levels, and rising interest rates. So that's why we spend a fair amount of time. It's not that the growth by itself is the only thing. It's that it enables an awful lot of what we want to accomplish.
Yeah, I think we're heading for a low-growth decade if we don't have the productivity surge that AI can give us. And I think what Mike is pointing out is it can transform a whole range of industries. You'll never see the accountancy or legal or even medical professions or teaching profession be the same again if AI has the impact that I think and Mike thinks it will have. But equally, we've got to have that productivity surge because without that, the inflation, the fiscal space being narrowed, the debt that we're running, and of course the supply side shocks and constraints that are in existence mean that as things stand, we're heading for a low-growth decade. AI is the way forward to take us out of growth, and I think Mohammed agrees with that.
No, totally. And it's critical because we have a debt issue that has to be resolved. We have an inequality issue. We need resources for critical transitions. So, the notion, as Mike and Gordon correctly said, that higher, more inclusive growth and more sustainable growth is a massive enabler to deal with all these other problems.
All three of you understand the risks involved, though. If globalization hollowed out manufacturing bases domestically in places like America, in the United Kingdom to some extent as well, and I'm asking the question, why wouldn't AI do the same thing to services? My question, if I'm a member, a citizen, someone who's got to vote, is why would I trust the same people all over again? Who should I trust to manage that transition and that integration of those technologies?
That's what my children say, my young teenagers say. You guys have messed it up. And it is true that we tried to create a more inclusive system. We tried to deal with the problems of the environment, but we couldn't get the agreement that we needed. And we tried to have more equity and better jobs. But I do think when I talk to young people, they want to see this change. The issue is not whether you have change or not now. The issue is what kind of change, and we've got to make that change inclusive.
Mike?
Agree. I mean, Eric Brynjolfsson talked about the Turing trap. The Turing test basically pushes you in the direction of automation. We want to push And policy should be pushing in the direction of augmentation, of giving people powerful tools that make them more productive. So this is the journey we're setting on, but it's not, I don't think, right to just capitulate and say productivity produces employment problems. It's at least more complicated than that, Jonathan.
But our global institutions have got to reform to be capable of dealing with this. They're not fit for purpose at the moment. And the IMF has got to be a crisis prevention mechanism. It's got to do proper surveillance of the world economy. It can't just be there for crisis resolution. The World Bank has got to become a global public goods bank and deal with the energy transition as well as human capital. The World Trade Organization has got to find a way of diplomacy and negotiation and arbitration working better than it has in the past. And we need a better concept of burden sharing. I mean, I cannot understand why, when you have a humanitarian crisis, and we have many around the world at the moment, all we seem to be able to do is pass the begging bowl around and hope that someone's going to produce some money. We've got to have a system of burden sharing, whether it's for the environment, or whether it's for public health, or whether it's for some of the other global public goods we want to do now. If you talk to people around the world, I've just come back from the United Nations, they all want this to happen. So what we need to do is show that this can yield the best results and then create the political will for this to happen.
As I'm listening to you, I'm getting the same feeling that I got when I read the book. This makes a lot of sense. And then I end up in the same place. Is there any evidence that people are willing to vote for it? Now, you say it's incredibly popular. You go around, you speak to people, and they're convinced by it. I don't see any evidence from recent general elections that anyone wants this vision that the three of you have.
I think people want hope. I think the lesson of COVID and of the energy and food crisis and people's reaction to the war in Ukraine is that things have got to be better than this. And I think those leaders that can show that there's a hopeful future. Now, you see Mia Mottley in the Caribbean producing her plan for global growth. You see now politicians in Africa talking about green growth. I do think that there's a movement now that says, look, we cannot have politics just as a negative sport where people are just attacking each other and it's all sort of about sound bites. I think people want politicians that can give them hope, and that's the next generation.
Mohammed?
I think he's absolutely right. I mean, there's A, people want hope. B, I think there's a broad recognition that the road we're on is unsustainable and it's getting more and more bumpy. And third, we're dealing with the loss of trust. And if we don't directly re-establish trust in our institutions, in our policy making, in global cooperation, things are going to get worse. I think the reason why we wanted to put this down is hoping to start a conversation on a set of steps. And we keep on saying there is no silver bullet. This is not a big bang, you do something tomorrow and then everything's fine. This is building a foundation that turns vicious cycles into virtuous ones.
Well, let's take the Federal Reserve as one example. You've written about this extensively over the last 18 months. I still remember a conference we did together in the summer of 2021 when you warned about what could possibly be coming and how ill-prepared the institution that is the Federal Reserve was for this moment. How do they recover from the mistakes they've made in the last 18 months to help contribute to the vision the three of you have?
So the recovery is starting. I think there's much broader recognition now that there's been 5 failures. Analysis, transitory inflation, forecasts, consistently too optimistic, action, too late, communication, muddled, and regulation. We almost had a big banking crisis just 6 months ago. So I think there's more understanding. And what we propose is a few steps that reduce the chances of that happening. Things that minimize groupthink, things that increase accountability. And without accountability, the independence of the Fed is going to be challenged going forward. So the Fed has huge interest in embracing the few things we propose in order to restore trust in an institution that's absolutely critical and that must have political autonomy.
Alarian, Brown, and Spence, Permacrisis is a book. John Farrell, just a wonderful effort there, a plan to fix a fractured world. Lisa, we can what's great about there, you may not know this, folks, Michael Spence is truly our link to the past of economics. He studied with the true giant John Hicks, I believe at Oxford, half a century plus ago. And Lisa, John Hicks, a contribution to the theory of the trade cycle, 1950. Nothing's changed, is what I think you could hear from Professor Spence. And we see it this morning when you talk about permacrisis. Yes, I saw Teslas outside the National Portrait Gallery in London. EU, let's go after Elon Musk in China over importing Teslas from China. And that takes the perma-crisis right down to the granular of this morning.
How are you proactive at a time where the parameters are so unclear? Where, yes, you do think about artificial intelligence changing a lot of how we do work and productivity, but then at the same time, could put a lot of people out of work, and you could have a permanently unemployed group of people. How do you have this discussion when people are worried on an existential level about their employment prospects, as we see in Michigan, in Hollywood? And that, I think, is the difficulty around having this conversation, but the necessity to have it in a real way.
But are they two separate conversations of the what if of AI out there somewhere versus the realities of diminished global trade and of the fragmentation that Georgieva at IMF talks about? I mean, the perma-crisis to me is basically a return to the 30s. I mean, that's, pre-World War II. That's really the angst here.
Not sure what the analog is. It is definitely a moment that calls for some leadership and some ideas.
We will have to see, and we'll have continuing coverage of that, particularly on Bloomberg Technology, on Elon Musk, Tesla in the EU. Futures -17, top of the hour, Mike Wilson of Morgan Stanley. This is Bloomberg Surveillance.
There is a limit to how much good news for the economy can be bad news for stocks.
There's parts of the market that have been very overextended.
The US economy is holding up better than expected, whereas the Eurozone is kind of in stagnation.
I do believe we're going to have a lot of turbulence over the next year.
I think the economy is going to be slower next year and that their earnings estimates are too optimistic.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Trying to reconcile bonds and stocks and failing. Good morning. This is Bloomberg Surveillance for our audience worldwide, live on television and radio. Tom Keene, Jonathan Ferro, Lisa Abramowitz. We are very much focused on the bond moves that we have seen over the past couple of sessions and whether they cohere with a resilient stock market, Tom, and a resilient economy that people seem to be gaming out for the foreseeable future.
A lot of sweat out there, as I mentioned with the drawdown earlier. That's a favorite phrase of Mike Wilson's. The drawdown is we're not even correction status. What everybody calmed down, we pulled back. Wilson is not 100% in cash, go to cash. He's not in the triple leveraged, all cash fund. It's measured. It's September.
Well, okay, and that actually is a great point. Is this just a seasonal blip? And if it is just a seasonal blip, is there actually any coherence whatsoever in the moves that we're seeing in bond yields and the understanding of what that would actually do in equities that have really been resilient? I mean, yes, to your point, there hasn't been that much gloom, especially yesterday, the Magnificent Seven actually outperforming despite what we saw with yields reaching.
Yeah, I'm glad you mentioned that. We had a nice recovery in equities, and I'm going to take a lot of solace in foreign exchange. I'm looking at it as a barometer, a litmus paper of the global system, as we just heard from Brown, Alarian, and Spence. But what I would go to, it's September. It's a Saturday. Michigan comes out. They score 30 points. They win. I mean, it's September. That's what happens. Michigan, Nebraska this weekend, bloodbath.
I thought you were talking about the Michigan Consumer Confidence
No, I'm not talking. I'm talking about what matters in Ann Arbor.
Going forward. Well, let's get right to the Daddy Check because we've got an incredible guest coming up, and I really want to get his view on the coherence or incoherence of this equity market. Down, although paring back some of the losses, S&P futures down less than 0.4%. Euro actually climbing over the 106 line and just kind of hanging out there after going below it. But to me, really, it is the 10-year. And the fact that it's 4.5%, and yes, yields have actually come down from yesterday, but still we're talking 4.5%, Tom, after people thought this was implausible.
As I said earlier, as I said to Kathy Jones of Schwab, it's an incredibly elegant chart. It's got log convexity, higher yield. It's well behaved on a set of log moving averages I use. I'm sorry, trend higher yield.
And meanwhile, we are focused also on gas price, just because we have seen that adding to the toxic brew of the past couple of weeks, which is oil prices higher, and people saying they could potentially go even higher.
There's so many different voices that we deal with. When we invented the program, we said, we've got to have a lot of different cross-sections of opinions. And so in meetings that we have, where do we meet? Like 3 hours a day arguing about this stuff. John and I just say, we need someone Bramo's comfortable with.
I am
so
comfortable.
here's the 8 a.m. comfortable segment for
Thanks,
Bramble.
Tom. I appreciate that. Mike Wilson of Morgan Stanley. He's been making a lot of warnings recently. The latest saying that risks are building for U.S. consumer stocks, writing, quote, this price action is picking up on slowing consumer spend, student loan repayments resuming, rising delinquencies in certain household cohorts, higher gas prices, and weakening data in the housing sector, the quinfecta of threats, or however many you want to say that. Mike Wilson of Morgan Stanley joining us now. Mike, how much pushback? We talked about this before. Do you still get the same degree of pushback that you did a month ago, or are more people listening and saying, wait a second, in the anecdotal data, this is starting to make sense?
Yeah, look, I mean, I think the question for investors is always price. I mean, we're in a late cycle environment. Let me just set the table a little bit, right? So we're in a late cycle environment for the last year. And when you're in a late cycle environment, there's a lot of uncertainty, right? I mean, people erroneously called for a recession in the first half of this year. It didn't happen. And now they may be erroneously believing in like this beautiful soft landing with some reacceleration next year. They probably overpriced that in the summer. So what happens is investors get whipped around by price action. And I would say what's happened in the last 2 months is we are seeing a breakdown again in a lot of the stock market. Okay, yeah, the overall averages are down 4 or 5%, not a big deal. But some of these consumer stocks are really, really struggling. And I think that reflects kind of what we were talking about a minute ago before we get on air, which is that the middle, lower end consumer definitely is out of excess savings. That's starting to bleed a little bit into the higher end now as well. We have the student loan moratorium. And I just think that's the wild card. That is the risk for the fourth quarter is can the consumer continue to surprise on the upside?
Can you see some of these retail and consumer facing stocks, these small cap stocks, get blown out, have their valuations completely decimated, and the rest of the market chug along? And no one noticed because the Magnificent Seven keep heralding all of the cautious votes of confidence from a lot of the consumers that see them as cash cows in perpetuity.
Well, it can continue if you don't have that hard landing. Okay, if you have a hard landing, then even the big winners will feel that, right? And I think that's what the market's betting on. The market's betting there is no recession. And we talked, the bond market, is that signaling, greater strength, or is that signaling that maybe the bond market's pushing back on the fiscal, kind of spending? I think it's a little bit of both. And if we don't have a hard landing, then the big names are probably going to continue to lead because they have scale and they have better balance sheets.
Let's go back to Graham Dodd and Cottle 101. Mike Wilson, how can you be as cautious as you've been and not have a massive cash position? What is your cash position? How invested are you within your caution?
Yeah, I mean, we're basically 95% invested. We're like 5% underweight equities. And we've talked about this before. We never go 100% cash.
Yeah, but the financial media does. It makes for great theater.
Of course. Now, what we can do, Tom, is we can be positioned more defensively within our equity exposure, which is what we've done, right? So we're skewed more towards kind of defensive growth, late cycle cyclicals as opposed to we're not grabbing for beta, we're not grabbing for small caps, we're not grabbing for the stuff that's really kind of vulnerable if things go sideways.
Okay, you're with James Gorman. He's saying, Mike, I don't care about any of this blather. Just tell me about the damn banks. I've been remiss on this. Yeah. Keefe Bruyette Index, you and I know it, we love it. And the answer is it's a grim chart. You go back to pre-California, pre-idiocy out there with one, you know the game that they went through. It's one of the barest charts I've seen in years. When do you know to load the boat on banks?
Well, look, it's the same story as the broader market, Tom. The bigger are getting bigger. There's concentration, in the winners again. It's like the higher quality banks are performing better.
So are you long Apple?
Well, I mean, we are in many portfolios, obviously, because it's such a big part of the index. But Apple's another category of stock where people are paying up for the quality of the balance sheet, the lack of need for financing. But the banks are representative of the broader market, okay? The higher quality banks are outperforming the lower quality banks. That's just where we are for everything.
Lisa Shallot emails in. She says, ask Mike Wilson with his easy day job. She's got the real job, managing money. Do you buy an R-squared tight to the S&P 500, or if I'm active managed, do I want to be idiosyncratic? Who did we talk to in London? Kathy...
That said who, what?
Kathy Wood Ark.
Oh, Kathy Wood.
Kathy Wood Ark. I mean, do I want to buy an R-squared tight to S&P 500, or do I want to get more idiosyncratic?
You want to be more idiosyncratic for sure this whole year, right? I mean, even though the S&P is outperformed, it's been 10 stocks. That's idiosyncratic. I mean, if you pick those 10 stocks, you did really, really well. If you pick the other 493, you didn't do very well. So the dispersion is really, really high. And it makes sense. Right now, the market's paying up for what I would call operational efficiency, cost leaders. It's paying up for good balance sheets. It's paying up for scale. Okay, will that change? Can we broaden out to the lower end of the market? if the market starts to believe that not only do we avoid a recession, but there's a reacceleration. That's what we need to see. That's what the market's trying to figure out. Hard landing, reacceleration. This purgatory land is we're just going to kind of slop back and forth, and the market's going to continue to gravitate to the lifeboats.
What does it mean to be defensive? And I keep asking this because some people say it's tech stocks. Some people say it's consumer staples. What do you say?
Well, I think it's both. I mean, obviously the market this year has voted with its feet saying they want to buy large cap growth stocks, not just tech, but growth stocks with good balance sheets that have scale. And I want to point something out that's really important for these 7 or 8 stocks this year. Now, X 1 or 2, most of the earnings recovery for these stocks has been a result of cost cutting, right? They got over their skis on too much spending last year. They reined that in, and so they've kind of manufactured an earnings recovery. If they don't see top line reacceleration, this is where we're starting to see a separation now, even in those 7. And I think that's going to be another story for the fourth quarter and next year's. The market wants revenue growth, not just cost-cutting stories.
What we're talking about right now is the bottom line. We're not talking about the rates picture and what that does overall to some sort of macro call on equities. Bank of America strategist came out today and said, do rates matter for stocks? And if so, it's not priced. Do you agree?
Well, once again, for some stocks, it's mattered a ton, right? I mean, I just think, look, we said this at the beginning of the year. This is the most difficult part of the economic cycle. When you are late, we know we're late cycle for one reason, because we got full employment. So you can't argue we're mid-cycle or early cycle. That's silly. What you can argue is that the late cycle period can persist for a lot longer than people expected, and that's what's going on. Rates are the one wild card. The rates have really surprised everybody, bond investors and stock investors. Normally in the late cycle environment, rates come down. Why? Because the Fed's done. As you know, this cycle is unique. That's the tricky part of the cycle, because the Fed can't be proactive in cutting rates ahead of the recession. So we're just going to ride this until basically you run out of gas. And that could be another year. We don't know the answers to that yet.
I mean, I find it absolutely fascinating here. I want to touch on this through the next number of minutes. Mike Wilson of Morgan Stanley with us. Folks, dovetail your revenue line, your animal spirit in the equity market with Ellen Zentner's nominal GDP.
Yeah.
Bring it in real GDP. Who knows what disinflation is? Even Jim Caron doesn't have a clue. But the answer is model out nominal GDP and how it affects your revenue line.
So this is really interesting. This is where Ellen and I are kind of aligned. I mean, I think we're the only bank on the street where we called for a soft landing and an earnings recession. Both turned out to be true. So why is that? Well, because revenue growth and pricing has been actually not as good as the sort of pricing and the inflation numbers in the government statistics. Now, Ellen is, I would say, far from excited about economic growth. I mean, she's not calling for recession,
right.
But she's looking for basically 1% GDP growth, real GDP growth.
3.84% nominal.
Nominal, exactly. And so, 3 to 4% nominal GDP growth. I mean, could that lead to 3 to 5% revenue growth? Maybe. Here's the risk. The economy is not what companies see. What companies are seeing in pricing is very, very different than what the economic statistics will tell you. Very similar to 2021, when companies were getting 20% price, when CPI and core CPI were saying 6, 7, 8. So now if you have CPI 3, 4, you actually have companies seeing deflation, and the market's figured that out.
Let's come back on that. Mike Wilson with us here. This future's negative 15, S&P down 0.3%.
I'm curious, Mike Wilson of Morgan Stanley, as we parse through all of these sort of muddled signals, what's the one thing you think people are mostly getting wrong? Is there a conviction, a consensus that you think is inaccurate right now?
Pricing. So from a stock standpoint, this is where we're probably most out of consensus, and we were most out of consensus in 21 on the other side. This is the boom bust, which is that what you see in the amplitude of pricing is much greater in the real economy than it is in the government statistics. And I think that there's this sort of illusion that companies can continue to pass on these higher costs. That's what's happening under the surface. The market's figuring out that many companies don't have pricing power. The question is, does that usurp even the big guys? We don't know yet.
So would you ever consider buying bonds?
Well, we have been buying some bonds.
Really?
Oh, yeah.
Have you ever done that before?
Yeah, of course. I mean, we have a big portfolio of everything. So we think there's value. In fact, our rate strategists have been pounding the table on longer duration. We think ultimately that will be good value. It hasn't worked so far in the last two quarters.
Let's go back to our Ute. I mean, I'm going to run out of time here, but is Mike Wilson all convertible bonds and preferreds right now? I mean, it's like back to our grandparents.
No. I mean, look, you have to own equities in your portfolio for one very simple reason. A, we are in a higher inflationary environment. Okay, we think it's a volatile inflationary environment. That is your protection against this new regime. Right. So bonds are still part of your portfolio too. They're a safer asset.
Right.
But the question is, in the near term, is this going to pay off? Yeah.
Really interesting. Mike Wilson with us. He is with Morgan Stanley, and he is not 110% in cash. Futures negative 14. Dow futures at negative 102. The VIX quiescent off the Bramall rally we saw yesterday, 17.22 on the VIX. On Washington, Elaine Kamerk joins us, a former Clinton official here on the shutdown. Good morning from New York.
So the economy has continued to exceed expectations in its underlying resilience. So if the economy is fundamentally much stronger than we realized, on the margin that would tell me rates probably have to go a little bit higher and then be held higher for longer to cool things off.
From Minneapolis, the aerospace talent, Neil Kashkari, Minneapolis Federal Reserve President. There, people go, why are the feds all different? Minneapolis is the research combine like no one in America looking at infant education, like 0 out to 6 years old. They own the absolute high ground on that. Gary Stern over decades and decades. And this education scandal, Lisa, that we have in America of our Ute versus so many other developed countries, it starts with Kashkari's Minneapolis.
The different regions all coming out with pretty different messages when it comes to where we are in the economic cycle as we parse through whether we're in for this higher for longer or whether we're in for something a little different than that.
What'd you take out of Mike Wilson? We had to slam into the break there, which we try to make. Farrell always gets the break perfectly. With me, they're like, they had the Bloody Marys out in the control room early this morning to say the least. What'd you take away from Mike Wilson?
That gloom is nuanced, and that it's difficult to understand exactly where we are. He says we're late cycle, and yet this is an era where the Fed is not expected to be cutting. Something's got to give. And to me, it's either rates going down because of some sort of depressed growth, or rates staying here and stocks muddling through. One or the other. It can't be both.
And what's fascinating to me, folks, and you heard it there early in the interview, and this goes to Gina Martin Adams of Bloomberg Intelligence and many others, the disease is I make a joke about it with triple leveraged all cash in and out of the market and all that. And these adults are saying, no, you have to participate. And I think that's underplayed. And through all of his bear market call, Mike Wilson has participated.
Yeah, he's not exactly saying go all to cash. This is somebody who's being nuanced in how he allocates at a time of a lot of questions with respect to where we are in the cycle.
Right now, on presidents in history across the American fabric, Elaine Kamerk joins us right now to say she's senior fellow at Brookings, former Clinton administration official, doesn't touch upon her wonderful books, which are really richly researched and written on the foibles of our presidents. Elaine, thank you so much for joining us. You are, I think of you and Michael Beschloss are the two I want to talk to this morning. What is the significance of a president on a picket line? Harry Truman wouldn't have done that.
Right. I think it's a big deal, and it's probably long overdue. The American labor movement has gotten weaker and weaker since the days of Harry Truman. In fact, it used to be that 33% of the American labor force was unionized. It's now down to 9%, of the industrial unions and a little bit more of the government unions. And at the same time, what we've had is this enormous ballooning in executive pay. There was going to be a come to Jesus moment with this. And I think now is the come to Jesus moment where the president of the United States is saying, if a company does so well that you are paying executives in the hundreds of millions of dollars, you got to do something for the workers.
Who has the voice of Coolidge, Hubert Heaver, and the rest of them? Who has the voice of business across America?
Oh, I think the president is very concerned about business across America. There's no doubt about it. And the old Republican Party, okay, the traditional Republican Party used to be the party concerned with business across America. Now this Republican Party is off in la-la land and can't even get a budget, right? Can't even keep the government open. So you've sort of lost that balance we used to have between the party of workers and the party of owners. And now we're at a crisis point in both situations.
Elaine, how complicated is this issue at a time where the Democrats have been trying to transition away from fossil fuels and lean into electric vehicles at a time when a lot of the electric vehicle battery manufacturers do not have unions? And this is part of what spurred a lot of the discontent among the unions. How confused is the messaging right now?
Well, it's pretty confusing and it's pretty difficult, but it is the price of progress. Right? I mean, we are going to move away from fossil fuels. We are moving to electric vehicles. You see more and more of them on the road. Here on the East Coast between Washington and Boston, where I travel a lot, there's a ton of EV charging stations at all the rest stops. So it's coming. And I think the unions need to cope with that and try to organize as much as they can. But the bottom line is we're out of whack here. I mean, we're seriously out of whack in terms of worker pay versus CEO pay. That's what's driving this. And that is why, by the way, the American public is on the side of the UAW and not on the side of business in this situation.
Is this enough of a headwind, or rather a tailwind for President Biden to get him over a hurdle that is increasingly big in terms of popularity, which is cost of living, which is his age, which is a question around some of these kind of confused messages coming out, supporting labor, but also having the energy policy that kind of goes against some of what he's talking about?
Well, it's good. That's a great question. And what you have to remember is presidential elections are not about the whole country. It's about certain states, winning certain states. This is going to be a big deal, a big effing deal, as the president himself says, in those states that are swing states. It's going to be important in Michigan, important in Wisconsin, important in a lot of those Midwest industrial states. And I think it's going to be huge in terms of his reelection.
For our Republican and Democrat listeners and viewers, Elaine Kamarck, does a president need a new vice president? There's such a tradition, second term, to recharge, reinvigorate, and figure out the politics of the next vice president. What's he do with the present vice president as he moves forward?
I think she stays exactly in place. And one of the things that's missing in all the discussion about Kamala is, guess what? She does really well among young voters, voters under the age of 45. Mm-hmm. And one of the things that is always forgotten in these discussions is that by the time of this election, people under 45 are going to be practically 50% of the electorate. Wow. By 2028, people who are today under 45 will be 54% of the electorate. Wow. There is a new generation taking place here, and they are a different generation than us baby boomers and the president's silent generation. And their politics are different. And guess what? They like Kamala Harris. They're happy that she's there. And that's why I don't think you're going to see any movement at all.
There is a debate between Gavin Newsom, governor of California, coming up with Ron DeSantis of Florida, a very unusual kind of debate at a time where Gavin Newsom is not running. Do you think that it would be a good thing if there were some other options at a time when a lot of voters are very concerned about Joe Biden's age and have said so in polls?
Well, they do say so in polls, but guess what? They don't vote that way. They said so in polls in 2022. They voted for Democrats. Every special election in 2023 has seen a growth in the Democratic vote. So I think, yes, people are concerned about Biden's age. You have to be. You have to be concerned about Trump's age, too. He's not a spring chicken. He looks like a walking heart attack, okay? You got to be concerned about age. But the fact of the matter is that is not related to votes. And they're two separate decisions that the electorate is making.
Elaine, thank you. So when's the next book out, Elaine, quickly?
The next book is probably out in November, and it's about disinformation in American politics.
Elaine, thank you so much. Elaine Kamarck, whether you're Republican or Democrat, she speaks her mind. And every time she's on the show, folks, I learned something. I had no idea the preponderance of people under 45 years old in America.
It speaks to the anger that a lot of people have that there isn't a representation that matches that at a time where the two frontrunners for the presidency are of a different generation.
It's great when she's on, whatever your affiliation. Very, very interesting. It's great when you do a data check where the tape's improved. It's 8:25 Wall Street time. We're up a solid 5. We were negative 23, Lisa. It was like edge of gloom there at 6 a.m.
Yeah, I mean we're moving away a little bit, and you can see a little bit of a retrieval from yesterday's 10-year yields climbing above 4.5%.
How many Fed speakers do we have today?
Just one today.
Just one.
Thursday's the bonanza.
Julia Coronado will be here talking Fed speaker today, macro policy perspectives. Looking forward to that. Please stay with us. Again, futures at negative 18. This is Bloomberg Surveillance. Bloomberg Surveillance on radio and television. Jonathan Ferro, Lisa Abramowitz, and Tom Keene. Jonathan Ferro in transit on the Gulf Stream. He'll be with us out of London off his very successful conversation with Gordon Brown, Mohammed El-Arian, and Michael Spence on permacrisis. It's a book making quite a splash this morning. Making a splash as well as Bramo. We've got a Bramo yield space, as they say, and to bring you up to speed on that 4.50% in the 10-year. I mean, stasis off of the theater yesterday.
But that's interesting in and of itself. Stasis off a theater that pushed yields beyond where people had previously expected, right? You would expect if it were just a blip on a thinly traded day that was a holiday for some in the United States and around the world, at a certain point, you'd expect a big bounce back today with people flooding in to buy, and you're not seeing that. And I think that in and of itself is notable.
Julia Coronado to be with us here in a moment on Fed Speak and all the rest of the parlor game. But first, Michael McKee with us, and as we talk to Mike Wilson about nominal GDP, Mike, you're looking at Anna Wang and what we've done at Bloomberg Economics, and they model out a 2024 of sub 4% nominal GDP. That about gets it done, doesn't it?
Yes, it would. We've also got the new Bloomberg Economist survey of
excuse me,
Wall
the
Street
Economist. My fault.
Yeah, well, here's
surveillance correction.
Here's the interesting thing. For September, the economists are now seeing 2.1% growth for 2023. In December of last year, they saw 0.3%. So we have really marked up growth. It's come in a lot stronger than the Fed has anticipated. The survey suggests we're going to see 3% growth in the third quarter, which would be lower than the Atlanta Fed GDP is forecasting, but that's up from 1.8% in August. So some real changes to the way people are looking at growth. And it's also, if you look at the forwards, take a look at the five-year forward, it's been pulled up by these growth forecasts. And Wall Street now expecting more inflation, which is why you get people maybe musing about the Fed having to go much higher and throwing out silly things like 7%.
Well, and we can get into why you call that silly things when Jamie Dimon said it of JP Morgan. I'm curious, though, when you start gaming out higher growth, what you make of the drivers of that. What do they say is going to drive it at a time where people talk about the toxic brew of student loan repayments and higher gas prices and savings running out?
That's the interesting thing. The growth forecast is for 2024 unchanged, and we're looking at a big drop in the fourth quarter GDP of only 0.5%, according to the economists, because what we're seeing is a 3% forecast for consumer spending, up from 1.6%, but then consumer spending falls off to just 0.7% in the fourth quarter because of all those things that you're talking about. So the only thing you can say is that economists have been wrong for the last year, and they could be wrong again. And the Fed just has to keep an eye on it, which is why they keep that extra dot in there and why everybody at this point is talking in terms of could, should, would, possibly raise it one more time.
Have people moved beyond the lag effects of monetary policy? Are we basically looking at a situation where people are coalescing around the idea that we've already seen the effects of rates going higher and of quantitative tightening?
There's still a division. on that, because you don't buy a house every day, you don't buy a car every day, businesses don't invest every day. And so as rates have gone up, it has more of an effect going on. That's the argument of those who think we're still going to be subject to lags. Others say, well, the market's priced this stuff immediately, so you don't have to have the same kind of lags that you used to. It's one of those things that the Fed doesn't know for sure, and so just has to take as it comes.
The case Schiller out today, which is on housing. It's old data, 2-3 months behind and all that. We're all stunned by a 0% statistic, even a negative statistic on housing. How does your study of housing data fold over to rent disinflation in America?
Well, it's an interesting question. John Author's talking about it in his column today, for those of you who haven't read his column on the Bloomberg. But the way the government looks at it is they take rents over the course of a year, and they assume that a certain portion of that, they ask people what you would pay to rent the house that you own, and that's how they come up with the housing numbers. Others suggest that you should take the changes in rent month by month, because rents are constantly changing and they have been going up and down over the past year. But that's not what the government does. Campbell Harvey down at the University of North Carolina suggests that if you did that, inflation would be 1.5%.
Right.
And so there's a significant difference in policy from that, which the Fed can debate at its next meeting if it has any data.
I knew you were going there, and we're going to continue the debate right now. This is important. Julia Coronado joins us with macro policy perspectives here. And Julia, I was setting Mike up for that question because I sort of knew what the answer would be. But if you play with the numbers, disinflation is really in trend. Why do we not believe that when I look at the bond market?
Yeah, it's, well, they're not necessarily inconsistent, because one of the key thing that has helped explain both cooling inflation and more resilient than expected growth is productivity, Tom. We are enjoying a productivity dividend as the pandemic frictions fade, both on the supply side, supply chains working better, and on the demand side, consumers have a normal demand pattern. They're more price sensitive than they were before. And what we're seeing in Q2 and the way Q3 is tracking is tremendous rebound in productivity. And companies have also been investing in transformation through technology that is labor saving. That should also pay dividends over time. We may end up with a better productivity trend this cycle than last cycle. That does mean that both we can have lower inflation and higher growth in bond yields. It's the secret sauce that explains all of this.
Okay, the secret sauce is there. I mean, Lisa, jump in here if you would. The secret sauce of this is the heart of the matter, which screams that we're data dependent.
Well, and that's the issue if we don't get the data, and we'll get there in a second, Julia. But just to build on what you're talking about, this idea of productivity filling the gaps at a time when we're learning to live with this new rate structure, do you believe in the long and variable lags, or have we already adjusted to rates at this level economically?
The way I think about lags, Lisa, is that there's two channels. There's the capital markets channel, and yes, the argument that through forward guidance, the lags there are a lot shorter than they used to be certainly resonates. We see the Fed engaging in lots of forward guidance and markets reacting instantaneously. But then we've got the credit channel, and that moves a lot slower. So something like commercial real estate has yet to really reprice and reset to a world of higher interest rates. The credit channel just takes longer. There's more fixed rate financing. And so the full impact of monetary policy, yes, still has long and variable lags. Of course, those are difficult to calibrate in real time, and that's exactly what leaves the Fed data dependent.
So we're looking right now at a situation where we could be entering a quiet period, sort of forced upon us, because we're not going to get data if the government shuts down for the foreseeable future. How much can you lean into the risk of upside or inflation risk versus the downside risk that we were just hearing from Mike Wilson of a consumer that's getting increasingly strapped, that's run out of savings, and that it can't really afford some of the prices where they are?
Well, so first, we've got a tailwind from spot inflation. Inflation has been trending pretty rapidly lower, much faster than the Fed expected. Rates are much higher. Real rates have just taken another 75 basis point leg up in the last couple of months. The Fed doesn't need to do anything here. As long as inflation keeps coming in below where it's been, on its way towards the 2% target, the Fed should just, say less is more and hold its fire. Inflation risk, the whole notion of reinvigorated inflation risk, comes from equating growth with inflation pressures. But if you have productivity, that breaks down.
First question, September 26th, Julia Coronado. Dr. Coronado, the jobs report that we see for September, do you have clarity with it, or is it a toss-up?
In terms of whether we'll get it or not?
No, I don't mean the shutdown. I mean, McKee's in charge of the surveillance shutdown central, but forget about that. Yeah. What are we going to see in that data?
Tom, in contrast to the GDP tracking, we really have seen some cooling in labor demand. We've seen it in job openings. We've seen it in hiring. Hiring has been slowing. It's been narrowing. So the sectors that are hiring have narrowed. We have seen no indication of broad-based layoffs. So the labor market is in this sort of stable moment where demand has cooled off considerably. It's narrowed to just a few sectors really driving job gains. So I would expect to see a pretty modest, moderate gain in jobs.
Julia Coronado, thank you so much. With macro policy perspectives, that's my first question on the jobs report.
What?
It's always September 26th of the month. This is a joy. Let me give you an anecdote of the romantic world of Bloomberg surveillance. I was sitting in our Washington office, and I noticed that there'd been some rain out or whatever of Capitals penguins. So I turned to Michael McKee, and I said, Mike, if I can get tickets in this section, 42 rows up, in Sheila Johnson's Washington Capitals rink, do you want to show up? And there was Michael McKee and I over Ovechkin's left shoulder on the power play watching the Magic. And that's what they did in Washington. They developed a set of teams that were just remarkable.
Yes, and now they've fallen off. They're not predicted to make the playoffs, unfortunately. The real issue for Washington this year is whether Ovechkin can score 40 goals again. He's about 70 some away from Gordie Howe's all-time record.
Or if Ovechkin can, it's not going to be Ovechkin Crosby. We saw that game. On radio right now, you're seeing the images from the game that we saw. But Michael, the real question is, can Ovechkin go over to the Washington Commanders and sell out the season?
I'm not sure about that, but the Commanders have been playing better. You got to give them that, I suppose. Now, we should warn people that neither one of us is Commanders or Capitals fans.
No, but
we have our own teams.
It's a little vignette that we just showed up one night at the Capitals for I think we were there for 30 minutes or something. But there was the magic of it. We'll talk about that in a minute with Sheila Johnson here, a force in Washington. Lisa, we've been remiss with all that's going on, and the shutdown's germane. But the jobs report, it beckons here in a short September.
Yeah, especially at a time where people are expecting that kind of resilience to continue because, you know what, I think jobless claims on Thursday actually has renewed importance after it keeps coming in lower than expected time and time and time again.
You're reading on this better than I am. I don't have the patience for it, but are we at a 75% probability on shutdown? Is that where we were?
Yeah, some people are saying that. Each person has their different expectations, almost a certainty. According
Lisa and I are going to recap the markets here. It's important. Standard & Poor's 500 down 0.5%.
Right now, we're looking at markets that are doing all right. I mean, they're basically staying around this 4 to 0.5% decline. But I was looking actually at which stocks were driving it lower. And it is consumer discretionaries. It is some of the big tech stocks. It's kind of a motley picture of people trying to game out what we can understand from yields where they are.
We're away from October 13th and James Dimon leading off the earnings season with JP Morgan. So maybe we're in an information gap there as well. Brent crude 92, make it $93 a barrel. The foreign exchange is really interesting. Not the tension that we saw at 6 a.m. This morning, but on sterling 121.81. That speaks volumes about weakness on cable. But Lisa, it's still the bond market we've got to go back to and the shock of a real yield of 2.15%.
I don't feel conviction this morning. I don't feel conviction anywhere, do you? I mean, is there any screaming buys? Is there anyone coming on and having a thesis that's not nuanced? No, everybody's kind of like trying to readjust to where we are and kind of get a sense of what's noise and what's signal, and kind of just kind of treading water until there's something a little more definitive.
That's a data dependency that's away from there. We have not touched on it, but a yen 148.85, the degrees of freedom that authorities in Japan have is, I'm on the edge of nil. Like their morning is 7 p.m. our time. Should we be alert tonight? I wonder.
Intervention, you think so?
I'm not predicting it. I'm just looking at yen 148.86, the challenges of Japan. We barely touched on that. Coming up, this is an extraordinary story. Sheila Johnson will join us. You, of course, know her from BET, the Johnson family, and all they've done in media and sports. It's a much more interesting story. This is Bloomberg Surveillance from New York. Good morning.
I think it's going to be hard to get inflation back to the target, and that probably means if inflation is sticky, we will see additional interest rate increases, and ultimately that probably does lead to a little bit more of a slowdown in the economy. Whether that's a recession or it's just a slowdown, it's hard to say, but it would be unprecedented to go through this type of a tightening cycle and not see us get to a little bit of slower economic growth than what we're seeing right now.
The economist, David Sullivan of Goldman Sachs, why don't they just say, like Moynihan come out and say, well, I was talking with Ethan Harris is retired now, but, I was talking with, whoever, Gapin over at Bank of America, or for Solomon to say, I was talking with our Dr. Hatzius, and what I find most interesting in his research is, and then I'd really sit forward.
Well, at this point, they have to kind of prognosticate and give their larger vision, and they are. And we're hearing about higher for longer pretty much across the board.
Let's revisit. We went light on this today. Farrell probably would have beat it to death, but there's the idea of James Dimon coming out with a 7% statistic on a Fed rate. Is that borderline irresponsible, Lisa?
Well, I think that it kind of speaks to where we are at this moment. And a big question as we speak to this moment is, what is the ramification for consumers at a time where costs are going up? And I want just to quickly take a look at some of the consumer discretionary stocks, the top consumer discretionary stocks, and they are underperforming the market. Kind of in the Mike Wilson vein of the world, when you look at the declines in Expedia, in Hilton, at the idea that you could have travel crimped by the idea that people are losing buying power. Expedia shares down 1.2%.
Losing buying power. Yeah. I went both ways on United. I could not find a place to sit. It was like a happy hour at the University of Illinois, years ago. I mean, I couldn't find a place to sit in the clubs coming and going from London because you had the Gulfstream.
Okay, I didn't have the Gulfstream, but I will say that there is still a lot of travel. So this is the big question. When does it really get used up?
When does it get used up? I'm seeing prices come down, which means people travel more. The only problem is hotels.
Yeah, well, and they're expensive.
Okay, right now, and this is a joy in this time of America, when we talk about all these different themes of diversity and the woke wars, the culture wars, and that, there is a breath of clarity coming out. Sheila Johnson, BET co-founder, she's author of Walk Through Fire, a memoir of picking herself up from her childhood, getting it done, getting totally slammed by a divorce, and keeping it going. She's, of course, done better than good over the years in Washington, as Mike McKee and I were talking about, a modest acquaintance with the ice hockey Capitals, with women's basketball, and the source. And she has written an exceptionally terse must-read. And I love how you end it. Nice. Granola guy's out in Utah, and you show up to pick up Robert Redford in a Humvee?
Absolutely, yeah.
And he gave you a lecture.
Oh, I got to know him because I was on the board of Sundance. Yeah. And I've admired everything that he's done for the film industry. And we just got to know each other, and he came all the way to Middleburg, Virginia, as I was getting ready to start construction, looked down on the town, and he says, you got to put a film festival here. We are now into our 11th year
of doing that. And
yes.
I like that you showed up at a Humvee, which speaks volumes about Sheila Johnson. I want to go back to the emotion of the beginning of the book, which people, you didn't come out of some fancy prep school and got it going with the first $1 million or $2 million.
No.
Take us before the first $1 million. What was the catalyst to pick the pieces up from your childhood?
Well, first of all, it was a learning area where I, for the first time in my life, had to grow up very fast at the age of 16. My father suddenly left. We were a middle-class family, first African-American, not the first, but one of 8 African-American neurosurgeons in the country.
Mm-hmm.
And so we had some sort of status in society. And for him to suddenly leave, it just left my mother broke. Women did not have the wherewithal to have our own bank accounts or anything. So that is stuck with me forever. And that has been the impetus in which I have decided to lead my life and take charge of it.
What people want to know from you, I'm going to slam it forward to the president. Lisa's got a bunch of insight as well. What do you think of the expression of our culture war now is witnessed by a corporate effort of diversity which seems to stumble on itself, witness Hollywood and mistakes made, or just the general debate over this word woke? You're about as anti-woke as I've ever seen. How do you synthesize that?
Well, I don't quite understand woke. I just know hard work is at the bottom of everything I do. My value systems are there, and it's really, really important that I continue to push on and not really, you know, focus so much on race, but I am very aware of it and the pitfalls. But I just try to fight through it, and I deal with the people that want to challenge me on it.
What do you make of some of the recent striking activity, particularly with Hollywood, given your intimacy with that, at a time where people are trying to take charge of their life and don't know what the future landscape will look like with artificial intelligence and streaming and don't have those guarantees? Do you think that there are legitimate issues that are not being dealt with responsibly and in the public eye from some of these companies?
Yeah, I think what's happening is all media is transitioning so fast. And even in the film industry. And I know people in the film industry, they're seriously concerned about what their future is going to look like. I mean, I deal with the film festival. I have a LA Film Advisory Board, and they're talking to me all the time about, are we going to get films this year? Are there still films being shot? Are they in the can? But I think this is something that we've got to watch and we've got to be careful about because the landscape is changing quickly.
You got these great vignettes. I want to take a vignette and take it to business as well.
Mm-hmm.
You're sitting there one day, you're over your Sanka coffee, you know, you're hanging out, you probably, you know, you're going, Ben's Chili Bowl, U Street lunch, I think we can do that.
Yeah.
And Whitney Houston wanders in. What's it like when Whitney Houston comes in the door?
Well, first of all, she's one of the most beautiful women I'd ever seen. She's very thin, very talented, but I also could just sense a little bit troubled. But I admired her. She's a great talent. And, you know, that was some of the fun things about BET. You would see all these celebrities that you've heard about, talked about, and they're coming into your studio. So, I mean, we really were the core of black media back then.
You were the core of it. And, you know, like you said, you wanted to be Ebony Magazine, really high-end and academic. And then, boom, it all changed. And, it, you know, in some ways it blew up and that. But I got to drag it forward now. Sheila Johnson, another cup of coffee, except it's a fancy cup at the Sunset Tower Hotel. It's you and Mr. Iger. What's your advice to the modern train wreck known as Disney?
Oh, my goodness. That's something I really can't answer. But I will tell you, Disney has always been a force. It's a force in media, in entertainment. And I'm just terrified about what's going on in Florida right now. I really am.
Well, if you push it forward from your BET experience, would you be able to found that company today, in today's world?
You know, this question has been asked of me many times. I'm really concerned about where BET is now. I think we need to look at it. I have not been happy with it for years and years and years. There's not enough balanced programming. And I just think that the landscape and the racial landscape of what African Americans are watching is changing. And I just think that we have got such a broad perspective of people out there that want something different, especially this younger generation. So we need to reevaluate what are the goals of black media and what are the answers? What is it out there that we need to answer?
The heart and soul of your voice, we got to wrap it up here, Sheila, in celebration of Walk Through Fire, but the heart and soul of your work is to find a middle ground. And in these culture wars, I was weaned on Edmund Burke, senator from Massachusetts. This is a long time ago. How do we get a fractured America back to a middle ground?
Well, I think what we're doing through the Salamander, through my company, is we're bringing in programming. I've kind of taken it from BET and into the hospitality business with the film festival. Also, I've been able to check the box on the diversity issues, where I bring in 41 of the top black chefs from all over the country to really celebrate food from the African diaspora.
Right.
We talk about these issues in panel discussions. I'm doing it in a fun way, bringing the American Ballet Theater in. I like to continue the entertainment part of it into my hospitality company.
Right.
And that's where we're answering a lot of the questions.
Sheila, thank you so much for joining
You're so welcome.
Today. Sheila Johnson, of course, of BET, Walk Through Fire, a memoir of love, loss, and triumph. Deeply personal and courageous book as well. Lisa, that really goes to the heart of the battle of voices like Sheila Johnson versus some of the woke stuff we get slammed over the head with every single day.
It's an important conversation to be having when we talk about all of the dissidents on the social level, to just be having an honest conversation.
What are we going to do at 9 o'clock? We got housing data?
We have housing data, The S&P, Case Shiller, CoreLogic, Tom Keene.
Case
housing
Shiller,
data.
always and forever. Good morning.